Hi again, and welcome to all of you. Very warm welcome to this third and final session in our Masterclass series. My name is David Hines, and I'm a senior manager here at Gold Standard. And I'm delighted that you're able to join us for this session today, which is going to be looking at project finance for carbon activities. So if you've been with us over the past two sessions, you'll know that we've already covered quite a lot of ground. In our first session with Pablo from Eco Securities, we looked at the long history of carbon markets over the last 2 decades or so. And then last week we had an in-depth session looking at project development under Article 6 of the Paris Agreement, led by a team from Perspectives Climate Group. And if you were there for that, you will know that we covered a lot of material, which is reflective really of the fact that it's quite a complicated architecture that has been set up under the Paris Agreement, and that we are really just at the early stages of learning how to navigate it. But one thing, of course, that's true is that without money to invest in carbon projects at the beginning, there would be no carbon market. And so that's our topic for today, to look at how carbon projects are financed. And before I get going with the session, I just wanted to say a word of thanks to the German Ministry for Economic Affairs and Climate Action, whose support has made this masterclass and the whole series possible. So soon I will pass over to our presenters for today. But before we do so, hopefully in a moment, you will be able to see on your screen a QR code for a quick poll to kick off this session. So if you have a smartphone handy, you'll be able to scan the QR code, and that will take you through to a short form which you can fill out, and it will give us a nice sense of who is joining for this session. Wait just a couple of moments for the responses to come in. Okay, so we'll update as we go. So we have people joining us from all over the world. We have quite a few people, it seems, from Germany, but also India and Cambodia, Bangladesh, Bahrain, South Korea. So we've got people from around the world, which is great to see. Where are people working? So we can see that about 40% of you are working at a project developer, followed by consultancy. Around 10% of you are working directly in some kind of finance or investment capacity. And our final question, which is about how much do you already know about the topic? So we can see that collectively, some of us know, well, let's see, we have about 10% of us who are self-judging to know quite a bit around it, but most of us are here to learn. So if that is you, that is great news, because we have a packed agenda. And we have two great speakers who are going to walk us through this topic. And I'm just going to introduce them briefly, and then I'm going to hand over to them and we're going to get underway. So first up, we have Kate Wharton, who's a managing director and head of natural capital at CrossBoundary Group, where she leads the climate and nature transactions and strategic engagements globally. In addition to providing investment advice support to projects and companies, Kate also currently is leading the design and launch of the Fund for Nature, which is CrossBoundary's investment platform for nature-based carbon projects in emerging markets. And Kate today will be joined by Makari Krause, who is a principal and co-head of Natural Capital Advisory at CrossBoundary Group. Makari's role is focused on helping nature-based projects raise capital in underserved markets. And he's worked with a broad range of project types across sub-Saharan Africa and Latin America, including many nature-based carbon projects. So his experience lies in financial modeling, structuring investments, and negotiations. So we're joined by two real experts in the field with lots of practical hands-on experience. Before I hand over to them, just a quick note on housekeeping. The chat has been disabled for this webinar, and that is mainly because of the amount of people who are here. But instead, you will be able to submit your questions via the Q&A function in Teams. In the first couple of webinars, we had loads of really great questions. And so one of the benefits of these masterclasses is that you can pose your questions directly to experts. And so we would really encourage you to do so. And we've made time in the agenda over the next couple of hours to pick up as many of those questions as possible. So with that, I'm going to pass over to Kate and Makari, and we look forward a lot to the session.
Wonderful. I think we're getting the presentation deck up on the screen. And thank you so much, David and team. We are very excited to be here today with all of you. You've heard our intros already, so just wanted to start with some very brief context on where we sit in the carbon finance world, and then we'll jump right into the course itself. So we are especially excited to be delivering this masterclass on carbon finance. Next slide, please. Because we are passionate personally and professionally about unlocking capital for high impact projects in emerging markets. This is CrossBoundary's mission, and it's our purpose since we were founded about 15 years ago. We're an impact investment firm with an advisory and investment management side of the business. So what that means is that we spend our time working closely with entrepreneurs, with business owners in emerging and frontier markets to help them raise capital. And that ranges from early stage capital, growth capital, project finance, carbon finance, and also working with investors, including development finance institutions, private equity, carbon investors, to help them originate and diligence projects and think strategically about this space. We also directly invest, so have a number of platforms in different sectors, and as David mentioned, are investing in the carbon space ourselves. We can go to the next slide. As you've heard, Makari and I both are situated within the National Capital team. That's where most of our work around carbon finance has happened to fall. Although of course there is a much broader range of project types besides just nature-based solutions, which we'll cover today. And this team is doing exactly the same type of work in terms of supporting capital raises, capital deployment, designing new financial vehicles, and also doing some work with government on the policy side for carbon regulations. And then finally, just wanted to point out a resource that we will be referencing today and is also available online. It may be helpful to you to dive deeper into certain topics. It's the Carbon Finance Playbook. And this is really our effort to democratize information to carbon finance in the same spirit as this presentation. So this may be helpful to you as well. You can Google it, and it can be downloaded on our website. We'll jump right in. As the team said, we want to make this as interactive as possible, realizing there's a big group on the line. So please do use the Q&A. We'll do our best to both answer those questions live, but then also we have built in, I think, 3 separate Q&A sessions throughout, and then additional time for Q&A at the end. You can use that for a quick break. You can use that to ask questions, and we'll do our best to get to everything. Also, I think the emojis are not disabled, so please feel free to use those as well if you so wish. Over to you, Makari.
Great, thanks, Kate. So similar to the poll that David ran at the start, we'd like to do an additional Teams poll to just get a little bit more context on where folks on the call are at in terms of their fundraising journey and thinking about raising capital for their projects. So please, again, scan this QR code, and then we'll give it a few minutes and go through a few of the answers here and kind of look at how the crowd ranges in terms of project types and fundraising journey and fundraising amount. Looks like a lot of responses still coming in, but from the first 20, it seems that the vast majority of folks are kind of in the early stage learning mode still, which is great because, I think this will be kind of a 101 on project finance for carbon projects. And so this is a good starting point. And then a few folks who are maybe midway through their capital raising journey, and a few folks that have successfully completed capital raises. As far as the amount of funding, so maybe unsurprisingly, most folks still unsure about the exact amount of funding that they're hoping to raise. That's one of the topics that we'll cover, is kind of how you go about determining that amount. And then it looks like there's kind of a fairly good dispersion across the different categories that we listed here, ranging from a few $100,000 up to maybe tens of millions of dollars even. As far as the type of capital, okay, so interesting. It seems most folks already know that they want to raise carbon finance. That's great, and is one of the topics we'll be covering. Some folks know they want to raise debt or equity, and then about a fifth of you still unsure, which is fine. And as far as project types goes, oops, sorry, let's see if I can scroll here. Yeah, interesting. Okay, so the largest bucket is ARR, and it seems fairly, and then the rest of the categories fairly evenly distributed across the other nature-based categories, and then across some of the engineered categories. So interesting. I think Kate and I come from the natural capital team at CrossBoundary, so a lot of the work that we do is nature-based, but this masterclass will not be focused exclusively on nature. So I think the kind of key learnings from this class will be applicable to any carbon project types, whether that's nature-based or what we call kind of engineered project types. So and then the final question, biggest challenges. We have a word cloud here. I mean, maybe not the most helpful word cloud for some of the big ones in the middle, but it looks like some other interesting ones: offtake commitment, investment, high risk, long-term, risk appetite, IRR expectations. These are all, I think unsurprising, and all topics that we'll cover in quite a bit of detail during the course of this presentation. Great. Maybe just seeing if anything changed across the first couple questions here. Looks like the distribution stayed fairly constant. So I think that's very helpful, kind of gives us a view for who's in the audience, and we'll try to tailor things a little bit. Right. Let's see. I get out of this poll. There we go. So the first section is really around determining financial investability for your project. And what we want to start with is kind of a quick overview of how you evaluate the viability of a project. And this is really around forecasting your revenues and costs. And at the end of the day, any forecasts that you do are only as good as the inputs and assumptions that you put into those forecasts. So doing accurate forecasts is really about creating the most realistic assumptions and inputs around revenue and costs to project out the cash flows of your project. And revenues and costs are really the big categories here. So starting with revenues, the most important things to think about here are your revenue channels. So, what kind of different business models do you have? What are you going to be selling? Obviously, carbon credits will be a huge component of this, given that this is a focus on carbon projects, but there may be other revenue streams alongside carbon. If you're operating a forestry company, you might have timber revenues, or if it's a climate smart agriculture project, you might have revenues from the sale of those agricultural products. I would say two most important kind of metrics for revenue are quantity, which is how much of each product are you going to produce over time. So if we're talking about carbon, this would be the number of tons that either you're avoiding or removing over the project life. And it's important to do a lot of the kind of background work to actually calculate those forward credit production curves, doing feasibility assessments and carbon accounting and all of that. And then the other side of it is the price. And ultimately, the revenue is basically the product of that quantity and price. And we'll talk a bit more about price over the next few slides, but the most important concept here is that for the life of your project, you'll need to create a forward price curve that basically gives you pricing trends and allows you to forecast out your revenue over what may be a 30 to 60 year project life. And we'll go through a few different tools in the next few slides that can help with some of this price forecasting. On the cost side, there are three main buckets of costs. There are your cost of goods sold, or your COGS. These are basically direct costs associated with producing and selling the credits. So these could be things like your auditing costs, having the VVB come. They could be issuance fees associated with the registry that you're using. We then have operating expenses, or OPEX. These are basically your kind of back office ongoing costs. So staff is typically one of the big ones here, but there could be other kind of maintenance costs, other operational costs, back office. And then finally, capital expenditures, or CapEx, which is the upfront investment or upfront costs that go into things like equipment or infrastructure, or in the case of a nature-based project, potentially also like the tree planting that would happen in the first few years. So as I mentioned, setting the forward price curves is one of the most critical elements of projecting out your revenues and therefore projecting out your cash flows. And what a forward price curve does is it basically gives you, a projection for how prices are going to increase or how they're going to change throughout the life of your project. And there are a few different inputs that can be helpful when developing a forward price curve. So starting on the left-hand side here, one thing that can be helpful to look at are third-party forecasts. So we'll look at an example in the next few slides, but there are quite a few organizations that will do their own forecasts, and they'll take into account things like market supply and demand, and we'll try to kind of put together basically a growth curve for pricing, carbon pricing over time. The other one that is maybe a little bit more accessible and can be helpful in you setting your own internal price curves are historical prices, which can be a very good predictor of especially near-term future prices. Maybe not so much for the longer term, but for the next year or next couple of years, historical prices are a pretty good proxy. Market outlook, looking at the overall economic conditions, changes in supply, changes in demand, changes in market sentiment, and kind of sentiment towards climate action and climate solutions can be helpful as well if you're kind of calculating your own internal price curves. And then finally, policy shifts can be very influential and can kind of cause step changes in pricing. So if you're expecting a new compliance market or new carbon markets regulation in your country, or potentially a change to one of the international compliance markets that might allow credits from your country to be sold into those markets, those can again create kind of a step change in pricing over time. That's very important to take into account. So looking at the historical prices, again, this is a good predictor of near-term future prices. And what we've done here is pulled some data from MSCI and Trove, a couple of the data providers in the carbon markets. These are voluntary market prices for a few different project types or methodology types. So in green, you see REDD+. In light blue, nature restoration, which is nature-based removals. In gray, you'll see energy efficiency, which is a lot of kind of cook stoves and maybe other lighting, other things like that, household appliances. And then in dark blue, renewable energy. And you see a few interesting trends here. For instance, the renewable energy and RED Plus prices have kind of been decreasing since their high in early 2022. Maybe flattening out over the course of the past year or so. But as you're thinking about future prices, you can look at these historical trends and probably make a fairly good estimate that these prices aren't going to jump up for either of these two in the future. One thing that is interesting to think about, though, like take RED Plus, for instance, there are potentially some changes to methodologies from some of the standards that could actually lead to a step change. So it's important to also take into consideration changes to, in addition to regulation, maybe changes with respect to how the standards operate and how they certify projects. If we look at something like nature restoration, you can see that there's a lot of volatility, big swings in pricing over the past few years. But interestingly, the average price for nature restoration has stayed fairly constant at a little under $15 over the past few years. And the other thing, these charts show the averages. The other thing to be aware of is that the carbon markets are by no means a commodity. And I'm sure some of the last masterclasses spoke about this a bit, but there are huge dispersions of pricing, even for a single methodology type. So if we take nature restoration for average, maybe you have an average price of $12, but there are some very high quality nature restoration projects that are selling for $50 plus, and there are others that are selling for just a few dollars. So it's very important to take into account the kind of the individual characteristics of your project when thinking about these prices. And these averages that a lot of the data providers kind of aggregate can be good benchmarks, but are not always a great predictor of your individual project. And then the other one is the third-party forecasts. So these are some forecasts that were developed by Bloomberg New Energy Finance, and they do a lot of kind of background calculation and analytics to create these forecasts, looking at supply and demand and the elasticity of supply and demand to basically build these forward curves. These, I would say, can also be a good benchmark, but again, will not take into account any of the kind of project-specific characteristics for your project. And so they should be used as maybe guidelines, but at the end of the day, setting your own forward price curve is a little bit more of an art than a science, and we'll need to kind of pull in inputs from all these different sources. So once you've set your revenues and costs and you kind of have the overall forecast, the next step is thinking about, looking at your cash flows and thinking about your upfront financing need. And the first most important thing to talk about is, how you calculate that financing need. And a lot of project developers who are maybe new to the space, new to project finance, will sum up the overall costs across the lifespan of their project and say, well, that's how much this project is going to cost. That's how much money I need to raise. But in reality, the vast majority of those costs will be covered by revenues from the project. So you don't actually need to raise outside capital for that. The upfront financing need really only needs to cover the upfront costs until the project becomes cash flow positive. So if we look at this kind of schematic on the right-hand side, you can see the revenues as the green arrows and the costs as the red arrows. And you'll see that there's this kind of upfront cash flow gap or cash shortfall in the first few years. That's really what we're trying to plug with our project finance, is making sure that we can cover those initial cash outlays and get us to the point where now the project is generating enough revenue to cover all of the costs. And the overall the overall financing need is basically the lowest or the most negative that the cash balance goes. And we'll look at this in more detail when we get to an Excel exercise, but that's kind of the overall concept. The other important concept when thinking about investment and when evaluating cash flows is the time value of money. This may be familiar to some folks, and there's kind of the old adage that a dollar today is worth more than a dollar tomorrow. And the reason for that is that if you have a dollar today, and let's say tomorrow is a year from now, you can put that dollar to work, and a year from now, you will have earned some return. So you could lend that dollar to someone, let's say for 10% interest rate, and in 1 year, if you had, let's say, $100 up front, that $100 would now be worth $110. So if someone asked you if you wanted $100 next year or $100 this year, you'd obviously take the $100 this year, invest it, and end up with $110. Similar, so within this kind of concept, there's also a concept of the present value, which basically looks at, what is the value today for some cash flow that you receive in the future. So if we go back to the same example, if someone offers you $110 next year, you can basically calculate what that is worth to you in terms of today's dollars, present day dollars. And that would be $100, which you could then invest and get to that future $110 value. So this is a concept. It's one of the core concepts with within the finance sector, within financing projects, and is really important to understand. And so on the right-hand side of this page in this table at the top, we've got a few different examples. And this is assuming that we make an initial investment of $100, and that basically generates a series of cash flows, so $10 per year for 5 years, and then $120 in year 5 as a lump sum payment. So if we look at the first row, where we're not doing any kind of time value of money calculations, we can essentially just sum up all of the cash flows across those 5 years, and that gives us a present value of $170. But once we start taking into account the time value of money and we start using different discount rates, or essentially what I was talking about as the interest rate before, you see that as those discount rates increase, that present value decreases. And that's because the future cash flows are being discounted by that rate to get to the present value. So at no discounting, no time value of money, that the cash flows are worth $170. But if you go up to a 15% discount rate, those cash flows are now only worth $93. And we have some graphical representations of that on the slide below here. So free cash flow is another concept that's really important in evaluating projects. And this is basically the cash flows that you will use to do this discounting that we discussed on the prior slide. And it has a very specific meaning in finance, and so we'll talk about how to calculate it. But on the left-hand side, I first wanted to just quickly go through the 3 different financial statements that you will typically see and kind of how they relate to one another, because the free cash flow calculation draws from these different financial statements. So the 3 are the income statement, the cash flow statement, and the balance sheet. These all 3 are really essential for understanding the overall economics and cash picture of your project. The income statement is used to basically calculate and show the company earnings and also the taxes that are owed. The cash flow statement is used to track the movement of actual cash through the business. And then the balance sheet is used to track the balance or the value of your assets, your liabilities, and your equity. So free cash flow is not actually directly visible on any of these financial statements. It can't be directly pulled from any of these statements. So it's something that you have to calculate on your own. And we've kind of showed the calculation here on the right-hand side. So typically you start with net income, you add in any non-cash expenses, you subtract out the net working capital, and we'll talk when we get into the Excel around a little bit more what that means. You subtract out any capital expenditures, and then you add back any net borrowing if you're looking for the free cash flow to equity. We'll go through an example of this, so if it doesn't make sense at this point, that's all right. And you'll also have an opportunity to ask questions about this. But using these free cash flows, we can now really start to do a lot of analysis on the economics of our project. So we talked about present value. The other concept that is actually more commonly used is net present value, which is essentially the present value minus the initial investment. So in the middle of this slide, you can see essentially the same table that we showed previously, where you have this $100 initial investment and this series of cash flows. You'll see the present value. So if we take, for example, the no discount scenario, the top row, you still have that same present value of $170. When you subtract out that initial investment of $100, you end with $70. And that's essentially the value of this project to the investor who's making that $100 initial investment. The thing you can see when you go down to the last row, the 15% discount rate row, is that we had a present value of $93. And so when we subtract that $100, we actually end up negative from an NPV standpoint. And that's because you basically are getting a series of cash flows that's worth $93 and you're paying $100 for it. So effectively, you've lost almost $7 on this investment. So the key concept with NPV is that if the NPV is positive, you're basically making money if you've set your discount rate correctly and your cash flows correctly. And if it's negative, then you're losing money or it's not a viable project. The other important concept is internal rate of return. And this is basically the discount rate at which the NPV equals 0. So the reason to use IRR, so the NPV gives you a dollar value for your project. So it's dependent on the overall size of the project, the overall amount of the initial investment, the value of the future cash flows. So it's very kind of project specific and sometimes doesn't allow for comparison between multiple projects. The IRR takes out a lot of that. So the IRR is basically gives you on a, let's say, per dollar basis, what is the discount rate at which that NPV is 0. And so you can look at that IRR as essentially the threshold. So if you are looking for a return that is above the IRR, then probably this project isn't going to be attractive to you. If you're looking for a return that's below that, then this could be an attractive project. So it's just another way to kind of evaluate the overall economics of the project and the return from the project. And finally, there are a couple other, in addition to IRR, there are a couple other methods that investors might use to calculate and evaluate returns. So something to be aware of. The first is multiple on invested capital, which eliminates the time value aspect that is incorporated into IRR and just takes the total cash inflows over the life of the project divided by the cash outflows, which would be that upfront investment. And then the cash on cash returns, which is basically similar, but is the annual cash inflows divided by the total cash invested. Investors may talk about this. They can be interesting to use, but I think in the project context, as the project developer, it's more helpful to look at things from an IRR standpoint. I'll stop briefly for Q&A, and maybe Kate, if you want to read out any of or respond to any of the questions that have been asked in the chat, that'd be great. I'm not sure if there are any yet, but.
Yeah, I've answered a couple as they've come along. And then just to flag, sorry, Makari, can you mute for a sec? And then just to flag, you can additionally use the option to vote up a question if you really want to have it answered. And some of the ones that are more useful to talk through in detail, we'll answer at the Q&A session, after the after the next piece. Oh, actually, sorry, it's now. Happy to go into the Q&A. Yeah, so the two questions I saw that might be useful to talk through in a bit more detail are one around, this is very common right now, how does the Trump administration affect the VCM and carbon project financing landscape? And second, a question around how do projects get this $50 per ton pricing? So for the first question, and feel free to drop others as we talk through these. So for the first question around impact of the Trump administration, obviously we don't know everything yet. We're still seeing how this plays out. You know, I would say generally across the investment landscape more broadly, not even looking at carbon, there's certainly a bit of a wait and see, particularly for investors who who are looking more at climate. And there's a broader pushback on ESG. That said, within the carbon finance space specifically, we're not yet seeing a slowdown, I would say, for carbon funds and carbon investors who have raised cash to deploy. They need to deploy that, and deals are still happening. Additionally, from the buyers or the off-takers who are market leaders in terms of American companies, we're seeing them continue to do deals. For example, Microsoft has announced several additional deals even since the new administration has come in. So far from those who've made those big commitments, we're seeing that continue. I think personally there's an open question around how many new commitments, new companies will join that leaderboard over the next few years. We typically see that, and even apart from the current environment, that many of those corporates want to act together. So we could see another wave, but I would expect that to happen maybe in a group rather than individually. And then, I think the other thing to obviously flag is the U.S. is not the entirety of the carbon market. So there is a lot happening elsewhere in the world that's really promising. We're seeing Corsia, so the airline industry, has now moved from a pilot into phase 1. That's real regulatory demand to buy carbon credits with certain characteristics. Additionally, we're seeing a lot happening in other countries around compliance markets. And voluntary credits being able to bridge into those markets. So whether that's domestic compliance markets and certain emerging markets, as well as in places like Singapore, that obviously have a carbon tax that allows the use of some carbon credits from other countries, and the partnership supporting those purchases. So jury's still out on obviously what will happen long term, but that's what we've seen so far. The second question was around what kind of nature restoration projects are currently selling for $50 plus, and how have they been able to achieve those prices? I'll chime in, and Makari, please add as well. I think the big things that the common characteristics of some of those deals are, one, obviously high quality, and that's quality both in terms of integrity on the carbon, so confidence from those buyers that that you're going above and beyond the requirements of standards. So, for example, Symbiosis Coalition, which launched last year as an advanced market commitment, led by 4 big buyers, have published a list of their quality criteria, which goes beyond what the standards require. So, any company or any project that is looking to achieve high prices, typically you'll want to do something extra. And some of those specific criteria are defined by Symbiosis, which can be a good reference point. We'll put that in the chat. And then on the beyond carbon, also having co-benefits for projects and being able to tell that story, to measure those benefits, and to really quantify. The other thing is scale, right? So there's a practical consideration of transaction cost. Right, it takes time, it takes effort, it takes capital on the side of buyers to do these deals, and so they want to be able to work at a large enough scale. I mean, these are really massive companies, and so they do have a minimum threshold there, and are looking for partners who can scale with them. Right, being able to support multiple projects or multiple phases of projects is beneficial in being a priority partner for them. Additionally, they're looking a lot at the track record of the developer and other partners on the ground, right? Their big concern is really about the risk of non-delivery, and so that will be a big part of the diligence. And then, I would say another factor is that there are typically happening in a bit lower risk countries, which not obviously not ideal. We want to see carbon deals happening everywhere, but I would say many of those deals are starting in places that are a bit more comfortable, and where the due diligence can be conducted by those teams. And then finally, I think the other note on price is we do often see there is a negative correlation between volume and price. So we would expect very large purchases to potentially have some discount. So you can sometimes see smaller batches of credits sold at a higher price, but then once you get to really large scale, that's obviously going to even out a bit.
Maybe just one point to add on the kind of pricing quality. So Kate, you mentioned co-benefits. There are actually certifications that you can get for co-benefits as well. So for instance, if you're doing a Vera project, you can get a CCB certification that looks at biodiversity and community outcomes alongside carbon, which a lot of buyers look at as kind of a marker of quality. And then really quickly, to also respond to Alberto's question around the kind of timing of cash flows. So Alberto, you're right. it can often take years for a project developer to finish the registration and certification, validation process with the registries, and then to actually start issuing credits. So that is another need, another reason why there's a need in carbon projects to raise this upfront financing is you have a lot of those costs that will be incurred during a period where you don't actually have revenue coming in from the sale of credits.
Yep. There was another good question on how to consider risk in the carbon project in that discounted cash flow. So we'll talk much more detail about risk generally in projects later in this training. In terms of calculating DCF and just the actual returns, we obviously recommend being conservative, and so looking at what different downside scenarios could look like, practical things that could happen in a project. Things are delayed. You get less carbon than you expect. Prices are different, and so we would look at different scenarios as well in calculating the expected cash flows. There's a good question as well around when the project is ready to start raising capital. I don't know if we want to talk about that now or leave that to a bit later, because we'll definitely talk around strategy, how to approach investors, when, and some of this also depends on who you're talking to. For some, it's the right time, pre-feasibility. For some, that's too early, and a big part of the fundraising process is also around bringing investors on a journey, so that they know you before you're ready to pitch for the full project. But I think we'll get a little bit deeper on that topic later as well.
Yeah, I think in the interest of time, let's move to the next section, and we can circle back on some of these questions in the future Q&As.
Wonderful. And yeah, just a reminder, please feel free to drop Q&As in throughout, and Makari will be monitoring it and vice versa. And there's a little button on the left side of each question with an up arrow. That's to upvote. So that can also help us prioritize if we get a lot of questions coming in. So jumping into the next section. So, and actually maybe just quickly go back to the agenda just to situate this a bit. Perfect. So I realized we didn't go over the full agenda. So we'll talk through the financing mechanisms available for carbon projects. So what types of capital are out there? How does it potentially fit together? We'll then do an Excel tutorial. So looking at the past two sections and putting some of these ideas into practice. We'll then do that deep dive into risks. So what are the risks? How do you price risks? How do investors think about risks? And what do you do with the risks that do exist within projects? We'll then do a deep dive into the investor landscape. So exactly who's out there, how do they think, and how to manage that, how to manage those conversations with investors. Then we'll get really in the weeds of different terms associated with debt, equity, carbon finance, and how to have those conversations. Then we'll do a couple of case studies at the end. So just to situate a bit in the flow. But jumping into financing instruments for carbon projects. So very basic. Capital can be raised at several different levels in an organization. This is a common structure or a common type of structure for developers whose primary purpose is running different carbon projects. Obviously, there are other business models as well, particularly for companies that have another business, for example, agroforestry or renewable energy, or timber, where you're not just doing carbon, that's one revenue stream. And so for those, the funding can be raised just within the company itself. But very often this is the type of structure that we see. And so, capital can be raised at any of these levels, and typically all of these levels. So at the top co, the parent company, this is typically where the actual staff of the organization sit, right? This is your management team, this is your finance team, and this is where you're raising typically risk capital from venture capital, private equity, or strategic partners who want exposure to the business itself rather than an individual project. Now, often in the carbon space, particularly for, again, developers who are just focused on carbon projects, this can be a space for strategic investors to come in. So That could be carbon investors, corporates, others who have an interest in the underlying projects. And so coming in and partnering at the top co level and allow them to to request things like right of first refusal to finance the underlying deals. The second level is the holdco. Now, this is not always in place, but often a holding company can be used essentially to hold a number of different assets at different projects. It's useful for a number of different reasons. So this obviously can provide exposure to a portfolio of underlying projects. It's also typically located offshore, so there may be reasons why an investor would want to come in at that level versus into a local entity. It can also be useful when you think around the broader strategy of the business in terms of building a platform, thinking about the eventual sale of stakes in a number of different projects, and as a way to aggregate small projects. And we'll talk a bit around the challenges of size, but this can be a way to offer a larger and more diversified exposure to carbon projects. And then finally, and where we will mostly focus in this training is coming into the project itself. This is typically set up through a special purpose vehicle. And this is where the investor can come in and only have exposure to that single project. Next slide, please. So we wanted to talk, so in the context of that project SPV, wanted to start with just a brief overview of project finance, because that is really where most of the capital is being raised here. So what is project finance? In short, it's a way of funding large capital-intensive projects where the repayment for that funding is entirely dependent on the cash flows of that particular project, not on the balance sheet of the sponsor or the developer itself. Key features of project finance include a legally and financially separate entity. So that's the special purpose vehicle. Typically, there's a mix of funding between debt and equity. And of course, the cash flows from the project are used to repay that loan. And usually this is with contracted revenues. So I noticed a few folks who are coming from the renewable energy sector. This is very familiar, right? You have a power purchase agreement, which secures your future revenues, and that reduces the risk of the project unless you raise low cost debt into that project vehicle. Similar concepts can apply here. The other key feature of project finance is that the lenders to that project vehicle have limited or no recourse to the sponsor's other assets, right? So if you're a project developer, you have 5 projects, the financiers of an individual project would not be able to have recourse to the developer itself. Now that said, that is in theory. I would say particularly in this space now, we very often see that it's a limited or partial recourse where you're not able to fully isolate that project, but it still is helpful. And then for a carbon project, this is a very complex diagram on the right, but essentially just emphasizing that that project SPV in this context is typically that local entity that is where all of the contracts sit, right? So your offtake agreements, although that can potentially sit at a different level, your supplier agreements, your contracts with the implementer of that project, if it's someone different from the developer themselves, agreements with community, government licenses, carbon rights. So that would sit with that project. The benefits of using project finance, we mentioned this idea of non-recourse or limited recourse, which is quite important. Additionally, it allows investors to only have exposure to that one project, right? So for many investors, they may be interested in a particular country or a particular project type. They don't care what you're doing elsewhere in the world. They just want that the ability to come into that particular project. So that is an important reason to set this up. And then, of course, there can be considerations around tax optimization, ability for local finance to come in, next slide, please. So before we dive into the types of capital available, just wanted to very briefly pause on this idea of blended finance, because I know it is a term that has become quite mainstream over the last several years. And in the carbon space, we often see a blending of different types of capital. So very basically, blended finance is the use of public philanthropic capital that does not need market rate returns, that is used to either reduce the risk or boost the returns of a project in order to bring in commercial investors. In practice, it's more often used to address the risk rather than provide additional returns, but you could do both. And there's a couple of different ways in which this concessional capital can come into a project structure, right? It can sit as senior equity, so it's paid last. It can be used simply for preparing a project or preparing a fund before it's being raised. It could be a pool of grants sitting alongside the project that's providing, sometimes there are grants provided for certain project activities and the rest is commercially funded. And then finally, you can have guarantee or risk insurance sitting alongside the project itself to address the risk. And I would say just the one challenge we often see with blended finance deals, because it does often make a lot of sense in this space. It does require aligning often very different stakeholders, right? So the concessional capital is very careful not to be unfairly underwriting private returns. They really want to see additionality and make sure that this is really required and not a nice to have. So that alignment can take some time. And then, of course, due to that complexity and often the extended time to pull these deals together, the transaction costs can be higher. So very much worth looking at, but also just want to flag some of the challenges that often arise. So next slide. Yep. So we'll talk through both what we call traditional financial instruments available, as well as then the carbon finance instruments available. The traditional finance instruments are probably things you're quite familiar with. So this is in order of cost of capital: grants, debt, mezzanine, and equity. I won't go too deep because these I think may be more familiar. But obviously on the catalytic side, this is great. Get as much grant capital as you can for projects. That's a no-brainer. That the downsides are typically that it can take a lot of time to pursue grants. They often come with restrictions on what you can use funding for. And what's often required to write a really good grant is obviously different from what is required to raise investment. And so just being thoughtful around the skill sets in the organization. Debt is obviously beneficial in that it is non-dilutive, so you're not giving up any control. It's also the lowest cost of capital of the commercial instruments. So, equity being the most expensive, debt being the least expensive. But that is because it is seeking lower returns and i.e. lower risk. The other thing that's typically that's quite important for debt is obviously having the cash flows to support interest payments, having the cash flows to support the repayment of principal. And it can be sculpted to the specific needs of the project. But the degree of flexibility obviously varies between debt providers. For some, it's pretty inflexible. There's no grace periods. For others, there maybe is more flexibility, and there are typically pretty strict covenants that come with any debt that you're taking on, which we'll talk about in the negotiation section later. The benefits, of course, are the cost of capital, and yeah, that's the main one. And then on the other side of the spectrum, we have equity. So this typically makes sense at the earlier stages when there's less certainty over future returns. The benefits, of course, is you're not then tied into an interest payment or cash coming out of the project on an ongoing basis. But it is, of course, the most expensive and has implications for governance, right? How decisions are made within the organization. and how the project is run day to day. And then finally, mezzanine is actually where we see most instruments in this space fall. This covers a very broad range of structures, but it has characteristics of both debt and equity. So typically, many of the downside protections, but I'm looking for some upside, and we'll talk about some of the terms commonly associated with mezzanine debt further as well. Next. So perhaps more interestingly are the carbon-specific financing instruments. So I'm going to put these in two buckets. One is carbon finance, where there is actual upfront capital available. And then the second is agreements that provide some certainty on future revenues. And it can be used to unlock capital, but do not actually provide that investment themselves. So on the instruments that provide upfront capital, we typically think about this in two ways. And there's different terms. So this is what we use and we'll use throughout this presentation, but you might hear other words as well. Pre-purchase agreement is where the buyer provides upfront capital to support that project development in return for receiving credits down the road. And typically this is a particular number of credits at a particular price. A streaming agreement looks a little bit more, is more equity-like in that typically that upfront capital is provided in return for a share of credits. So if the project produces twice as many credits as it expects, the carbon streamer would receive double. If it's half, it would receive half. And there's of course terms limiting the degree of variability in practice, but it looks more like that equity position. And then on the other side, offtake agreements are obviously quite important. This is the sort of PPA equivalent from the energy space. And this is simply a commitment to purchase a predetermined volume of credits in the future. It's useful because you can then take that to another funder and say, we know who's going to buy this, we know the price, and that helps to underwrite some of the market risk, particularly as there are questions around potential volatility and future prices in the market. So that helps provide that certainty. Of course, it can reduce the upside of a project, but it also protects against potential downside. The other reason why offtake agreements can be really helpful, besides simply the risk reduction, is that they essentially show that the project meets a buyer's criteria, right? Buyers have obviously their own intensive due diligence processes. And if you can demonstrate that you've gone through that, someone wants to buy this, and that is a credible name, that also helps build investor confidence, even if it's a small offtake agreement. And finally, a brokerage agreement is simply a agreement from broker or someone who wants to sell or market credits themselves, and that typically is in return for a percentage of the value. But this is a pretty specialized business, and if you don't have as many relationships with different buyers, it can be a great way to ensure the distribution of credits as long as the fee is reasonable. Next. So that was sort of the theoretical view of all the investment instruments available in the market. Obviously, in practice, it's not equally available. Period. There are gaps, and of course, depending on geography, project type, size, some of these instruments will be on the table and others may not be. And so we'll go into that a little bit later. But as a generalization, we tend to see gaps for that early stage development costs, as well as for financial investors in this scale up. Typically, where we see more funding available at the moment is those carbon specific instruments, and cash from strategic investors who have an actual interest in the carbon and are not just making a financial investment. And key to this entire process, of course, is trying to bring in the right type of capital at the right time as the project is de-risked, right? Because as you reduce the risk, you're also able to bring in lower cost of capital. And so we typically see you want to raise, put some of your own capital in, get some grants, then raise the sort of construction finance, and then potentially refinance that later in order to achieve a lower cost of capital. Next slide. Yeah, and finally, none of this will be new, but there are some common challenges that that folks face in raising capital in the space. Obviously, we talked some about the cash flow timing, so simply the fact that it takes time to issue credits. Investors use returns measures that have an element of time, and so that is a bridge that has to be crossed. Transaction costs and structuring complexity. So, unlike a space like renewable energy, where you have the full capital stack available in the market, you have pretty standard structures and knowledge of how to do those structures. A lot of carbon finance is doing things for the first time and doing things with new investors, new buyers, and that simply can increase the complexity. On the other side, of course, from investors, very few investors have that full understanding of carbon markets, have that full in-house capacity to really diligence projects. And so, outside of just the carbon investors. And so there's definitely a significant education process if you're talking to someone who's not previously invested in carbon markets. And then, of course, in addition to real risks of projects, there's simply the perceived risks of this being a new space, uncertainty or lack of knowledge about carbon, and depending on the geography that you're in. So now that we've covered the basics, we'll jump into a brief Excel tutorial to put some of those concepts into practice.
Great. Thanks, Kate. And some good questions in the chat during that session. At the end of this Excel tutorial, we'll reserve a bit more time for questions. We can come back to some of those, and then we can also look at some specific questions on the Excel, if there are any. All right. So, just to orient ourselves on this page here. So essentially what we're going to do is walk through the financial statements for a illustrative or kind of mock carbon project, and then look at how we will calculate the investment need, how we will kind of determine the fundraising strategy and what types of capital we want to raise, how to calculate the free cash flows, and then finally how to look at the returns and valuations. So I will unhide these sections as we go through them. The other thing to note is we've got the kind of project duration years along the top here. So this project assumes we're starting in 2025 and going 60 years out to 2084. And the place we typically start is with some of the operational metrics, which are the key drivers of revenues. So the most important thing, and this is something that you'll need to develop for your projects, and that there'll need to be a fair amount of kind of background calculation and analysis on, is the number of carbon credits generated. So we've put in a kind of illustrative curve here for carbon credits generated, and then obviously you need that forward curve that we discussed earlier on the price. Here we're assuming we start at $20, and I think this is just kind of a smooth escalation of like 5% per year, just to build an illustrative curve. The other thing that we haven't discussed yet is around the issuance cadence. So not only is there typically kind of gap between the start of the project and that first issuance as you're getting everything set up, but oftentimes projects, especially like nature-based projects, will not do an issuance every year because there are fixed costs associated with them. And so in this case, I've assumed that there's an issuance every 3 years. So first in year 3 and then in year 6. And so there are no credits available for sale, at least no new credits available for sale in those interim years. So essentially, when we look at the number of credits issued here, we're issuing everything that was generated over the past 3 years, and that's what's available for sale. Getting into the income statement starts with revenue. Here you can see we're kind of bringing in revenue according to that quantity and price, the issued quantity and the price in that year. And then on the expense side, we have cost of goods sold, just assuming 5% of revenues. Basically, this will be fees and such. Again, this is very simplified relative to what you would have for your projects. For operating expenses, we've kind of put in some example illustrative operating expenses here. And then we have depreciation. We will have interest payments if we choose to raise debt for this project. And then we have corporate income taxes, and finally net income. One thing to note about the net income here, you'll notice that it's negative for the first 5 years of the project. the first year in which it's actually positive is 2030. So this is an important kind of first indication of our cash need, although this is not really, net income isn't really what you should be looking at for cash, because it's more of an earnings and accrual basis rather than a cash basis. The next financial statement is the balance sheet. And again, this has 3 sections to it: assets, liabilities, and equity. This is, again, also, very simplified. We've got a cash balance on the asset side. We also have accounts receivable. This is essentially what your customers owe you. And I've just put that at 5% of the revenues. And then we have some property, plant, and equipment here. We've assumed some upfront capital expenditure on property, plant, and equipment. For liabilities, you have basically the opposite of accounts receivable, which is accounts payable. This is what you owe, what your project owes to its suppliers. And then we have some long-term liabilities, which will make more sense once we get into the financing. But unearned revenue is basically how you account for a carbon financing deal. And then debt is obviously the looking at the balance of any loan outstanding that you would have. And then finally, equity, which is retained earnings, which comes from the income statement. This is basically the cumulative kind of running sum of net income and then any other equity investments here. And then finally, we have the cash flow statement. There are 3 sections of the cash flow statement. There's cash from operating activities. This starts with net income and then basically adds or removes any other cash items or non-cash items that were included in net income. This is the reason that net income is not a good indication of cash, and why you can't use the income statement is because there are certain non-cash items like depreciation that are included in there which don't have an impact on cash. And there's similarly other things like capital expenditure, which is a cash expense, which is not included in net income. Next, we have cash flow from financing activities. Let me just zero out the equity investment really quick. So there should be nothing in here from financing activities, but we will fill this in as we get down into the kind of upfront financing section. And then cash flow from investing activities, the only thing we have here is the CapEx. So this is basically upfront expenditure on that property, plant, and equipment over the first 4 years. We're saying we have basically $1 million of CapEx needed. And then the result of the cash flow statement is a starting cash balance, a change in that cash balance during the current year, and then an ending cash balance. What I'd like to do is start with, so right now the starting cash balance is 0. I think it's oftentimes helpful to say that there's going to be some kind of a contribution by, let's say, the project founders or sponsors. So I'm going to say that we're going to put $100,000 in here as basically cash that we're starting this whole project with, coming from the founders. So the next step after this, now we've kind of gone through, we have our financial statements, we have all of our cash flows from the cash flow statement. So how do we actually go about calculating that investment need? And the easiest way to do this is to look at the cash balance. And so I've pulled that just directly here from the cash flow statement, the final line of the cash flow statement. And if you look at this cash balance, you see that it's, we even though we put in $100,000 up front, we end with negative over $700,000 by the end of year 1. And then that negative balance continues to increase all the way through 2029. For 5 years, we continue to basically burn cash and go deeper and deeper into the hole. And then you have, a positive cash flow a positive cash flow. So if we look at the annual flows here, you have 1.7 million that comes in net in 2030, that reduces the cash balance and so on. And eventually you reach a point where that cash balance becomes positive. So this is really what we need to use in order to calculate that investment need. And the easiest way to do that in Excel is just to do the min function to take the minimum of these cash flows, these cash balances. And that will basically bring in the lowest point, which is that year 2029, negative 3.6 million. So this is essentially the funding that we need to find. We need to find 3.6 million that will bridge us during this period where we have negative cash flows. So I want to quickly switch to another poll, and I want to ask folks on the call how they think we should go about plugging that funding gap. So please scan this, give us your responses. I won't share the screen of the responses, but I'll just kind of read through them and give you guys an overview of what you think. All right, so seeing responses starting to come in. Looks like about 50% of folks think we should go the pre-sale route, pre-sale credits, carbon finance route, a little over 50, almost 60% now. 25% think we should go the equity route, and 20% think we should go the debt route. Looks like it's fairly stabilized on that. So let's look at the different options then. So in this next section, we've got basically a kind of structure built out for these three different financing instruments. The first, equity, is quite straightforward. So basically, we can raise equity into the project by selling ownership in the project. And a lot of folks, as Kate mentioned, there's kind of a perception that equity is almost free because it doesn't have any cash repayment that's required. But ultimately, you're giving up ownership of the project. So it's actually one of the most expensive forms of capital. But it's typical to have equity in a project, and it can be good for raising other types of capital if you have, again, some equity at the project level. So I'm going to say, we need almost $4 million. As a starting point, I'm just going to say we're going to raise $1 million of equity from a private equity or venture capital investor. So you'll see now that shows up on the cash flows from financing activities as an equity injection. And then it also shows up on the balance sheet as that same equity injection here. That then reduces our cash need by that $1 million. So now we need 2.6. But we still need to raise the remainder of that. So our next option is debt. What I've done here is I put in some kind of preliminary assumptions. So an interest rate and a duration for that debt. These are kind of just very rounded ballpark figures. But if we say we want to raise, let's say the 3 million, let's say we want to raise 3 million from debt, that would cover all of our funding need, and it would give us a few $100,000 extra, which is oftentimes good just because you're not sure, there might be overages in some things that you haven't predicted. So if we put in $3 million, you'll see that the debt schedule gets filled out here. So you have a beginning balance, a draw, a repayment, and an ending balance. So we draw 3 million, we then repay that over time, and it goes down to 0 by 5 years later. But we have these principal payments, that's what draws down the balance, and then we have these interest payments here. So if we look at now how that flowed through, so going back to the financial statements, you see that there is now debt on the cash flow statement coming in here, and then you have those principal payments coming out. And if you go to the balance sheet, you similarly see that balance of that debt over time going down as it gets repaid. Now, if we look back at our investment need, previously it was 1.6 million. It's now actually gone up to 1.8 million. So why is that? We raised $3 million of debt, but we actually have a more negative cash balance than we had before. Well, the reason for that is that basically you've raised that 3 million, but you've basically repaid almost all of that 3 million before you hit that point at which you have the most negative cash balance. And in addition to repaying all that cash, you also paid another, $1 million or more of interest. So it's actually hurt our cash position to raise this debt. That doesn't mean that debt is always a bad idea, but the problem with this debt specifically is this duration. You need cash to bridge you all the way out to 2029, and this debt is being repaid before then. So this picture would change if you were to change these assumptions around the debt. So let's say it's very unrealistic, but let's say you got a 20-year loan, right? Now, if you look at it at what it's done to the cash balance, you're repaying that loan over 20 years. Now it actually has helped that cash position. So from 2.6 million, it's gone down to 1.2 million. So a loan like this would be helpful, and increase. If you get a better interest rate, that would help even further, right? So now we need only 600,000. But the reality is that, well, and one other thing, let me go back to the original assumptions that I had. The other important thing to to look at for debt is whether you're actually going to be able to service that debt and whether someone will lend to you. And one of the common ways to evaluate that is with a debt service coverage ratio. And this basically takes your cash flows and it basically divides your cash flows by the amount that you owe on the debt. And it's very unlikely to find a lender that will lend you money if you have a negative debt service coverage ratio. And the problem with this project and raising debt for this project is for those first 4 years, you don't have positive cash flows at all. So you have negative debt service coverage ratios. So for this project, I would say, unless you're in a very special situation where you can get a low interest rate and very long duration, debt probably isn't going to be the right fit for the project. So that brings us to our final option, which is the carbon stream. So again, we need to raise 2.6 million. I'm going to round that up to 3 million, so we have a bit of a buffer, and I'm going to put that in there as the purchase amount. So this is the amount of cash consideration we're getting upfront. The other assumption you need to make for a stream is the amount of credits that streamer is purchasing from you. So I've put that at 30% right now, which means that for that $3 million, given the carbon generation curve from the project, you're looking at selling about 700,000 credits. Obviously, that could vary depending on whether your carbon goes up or down over the life of the project. That then implies a purchase price. There's not an actual purchase price because they're purchasing a percentage of credits, but the implied purchase price is only $4 in this case. So you can play around with these assumptions. If this $3 million only buys them 10% of credits, then now that purchase price is $11. So these are, when we get into the investment terms section, we'll talk a lot more about kind of what that looks like, how to think about these terms. But if we now go up and look at let's look at the financial statements to see how that flowed through. So on the cash flow statement, you have the pre-sale of credits, which shows up as unearned revenue, and then that gets drawn down over time through the change in unearned revenue. And similarly on the liability section of the balance sheet, you have that unearned revenue from the pre-purchase, and that again gets drawn down over the life of the project as it gets repaid. It is similar to a loan in some ways, but it's repayment in actual carbon credits. It also has some equity-like components to it, so it's a bit different. But if we look at the cash balance, you can now see that the investment need, which was negative before, is now positive. So now we have enough cash, and we look at that balance over time. We end year one now with over $3 million in the bank. And then over time, we draw that down and we hit that minimum in 2029 again, but we don't go negative. So we have enough cash, and then we get to a sustainable cash flow position and we're good for the rest of the project. So this carbon stream has basically fixed our issue. It's cost us, we've pre-sold 30% of the credits, but we've solved our upfront cash flow need. So now coming back to the concept of free cash flows, returns, and valuations, which I talked about in the first section. So this is going to hopefully make things a little bit more real for folks. So, we have operating cash flows on our cash flow statement, and there's a temptation to just use that as the free cash flow. But you'll notice down here that those operating cash flows don't include certain things that we're including in our free cash flow calculation. They don't include any of the CapEx. That's one of the really important ones. But there are certain other kind of non-cash expenses that don't get included in operating cash flows. So you can't use that, and you actually need to go through this process of calculating free cash flow. And one of the important concepts for free cash flow is working capital. Working capital is it's basically kind of a measure of the amount of cash you need sitting in the business to run your operations. And it's really the difference between current assets and current liabilities. Although in many cases, the actual cash sitting on the balance sheet will be excluded, especially if there's a big cash balance like this. So this is one of the components that's used to calculate those free cash flows. But for the calculation, we start with net income. We add back depreciation, which is a non-cash expense. We subtract the change in net working capital. So this looks at current minus prior. So how much did net working capital change? And then we subtract out the capital expenditures. If you're looking for cash flow to equity, which is what we're using here, then and if you had debt on the company, you also would add back any net borrowing. But because we decided not to go with debt, that's irrelevant in this case. That gets us down to those free cash flows. And the free cash flows follow the operating cash flows, but they're slightly different. So it's very important to make these adjustments to get to that free cash flow. And this is ultimately what we'll use to calculate the returns and the valuations. So first, calculating net present value. In Excel, there is a very handy formula. You just type NPV, open parentheses, and then it prompts you to choose the discount rate, which I've set at 10%, and then the stream of free cash flows going into the future. So I'll select them for the entire project life here. And you'll see that and then the last thing, which is easy to forget and which I almost just forgot, is because we're looking for net present value, not present value, you also need to subtract out that initial founder investment, the equity that the founder has put in year zero. That then gets you to the overall dollar value of the project, essentially. So a little over $2.5 million. So this is a very important figure. I mean, this basically tells you what that project is worth. And so, we said we were going to raise equity. If the project is worth 2.5 million and we raise $1 million of equity, then we basically need to hand over almost 40% of the ownership of the project to that equity investor for them to come in. If we say that this is essentially our enterprise, our project value. The other important concept which we discussed is IRR, and luckily there is another Excel formula. You just type IRR, and then you select that same series of free cash flows, and that will basically just spit out the discount rate at which the NPV is 0. So it won't be exact because it's probably rounded, but if I was to put 15 in here, that would get us pretty close to 0 on that NPV. So that's kind of a very quick overview of the financial statements, and then how you go through this process of determining the investment, figuring out what type of determining the investment need, figuring out what type of investment you're going to raise, looking at the free cash flows and the returns and valuations. So I'll stop there and then go back to the PowerPoint, and we'll move to Q&A.
Great. So Makari, I know there was a specific question around, could you please show again the effect of pre-sale of 30% credits at a discounted price?
Yes. So this is talking about the carbon stream here. So basically, let's see, here we go. So we've said we're going to bring in a $3 million upfront investment, and for that, the streamer is going to own 30% of the credits. So what I've done is I've basically calculated an implied price here. There is no actual price associated with this, but given what we're projecting as far as the carbon credits will generate, if we take that 3 million and we divide it by the number of credits, which is 30% of the total credits that the project is generating, that gets us to that $4. If this changes, so if instead of buying 30% of the credits, that 3 million buys an investor 40% of the credits, then that implied price goes down. And vice versa, if they're only buying 10% of the credits, then that implied price goes up. Does that answer the question? They're basically buying a fewer number of credits for the $3 million, depending on what percentage of overall credits they buy.
Great.
Are there any other questions on the Excel, or should I stop sharing it?
That was the only one on the Excel specifically. We had a number of questions around, can you share the Excel? So we will look into how to do that as we in the background of this. But happy to share. Maybe we'll just collect info from whoever wants to receive it. I've answered a few questions in the chat. So there were some questions around where are grants available? How do I find those? We put a couple of links for current opportunities, answer some questions specific to renewable energy. And then I think a few that were not answered include, let's see, what can governments do to ensure they are providing additionality, and what else can governments do to to mobilize private capital? That is a very big question that we probably don't have time to go into in detail here. I would say in terms of additionality, that's maybe a separate conversation. I put a few notes in response to another question as well. The determination of additionality is really happens at the methodology level. So the way in the voluntary space, the market is structured is you have standards. So a group like Vera, Gold Standard, others that have endorsement from a group called a CROA, so sort of the overseers of standards. And those standards, their job is really to develop, maintain a set of methodologies. That's the specific guidance for different project types that says, here's the criteria that you need to reach in order for us to issue a credit under our standard. And so the additionality is one of those criteria that is defined at the methodology level. Now, of course, a buyer may have additional requirements or additional things that they expect, but that is done within the issuance process with verification from a third party. So in terms of governments doing something additional, I don't have any specific recommendations there, except to obviously look at the specifications of the methodology that they're choosing. In terms of other things governments can do to mobilize private capital, in the carbon space, one of the big challenges that we see, particularly in emerging markets, is simply the lack of regulation, right? Most carbon rights fall in some sort of gray space. And so the more confidence governments can provide in terms of investor protection of investor rights, and not even related to carbon, but everything else in terms of a strong business environment obviously helps. What investors do not like is uncertainty. And so providing clarity on what's the tax going to be, what are the requirements for export or issuance of a corresponding adjustment, what are the requirements around benefit sharing? Because as soon as the rules change, that's when investors will look elsewhere. And particularly in the voluntary carbon market, one of the unique features is that it's a globally competitive environment, right? If a country has bad regulations or no regulations or poor enforcement of those regulations, an investor can look at 170 other countries. And so there really is, you really have to make it a place that investors want to show up, especially if there are other challenges in operating there.
Maybe
there's
one other.
Yeah.
Yeah, I was just going to respond to one other question around prices and margins. I think it's an interesting question. So how do higher prices actually impact developer margins? And the question is, should developers think of this as a cost plus through a cost plus lens? I think this maybe gets to a slightly more philosophical question, but oftentimes it's not really how we think about it, cost plus. At the end of the day, we're operating in a private market here, and the price is going to be determined ultimately by supply and demand. And there's potentially, a lot of upside that can be gained for the projects and for the communities beyond just, some margin above the cost. So it does somewhat tend to be true that higher cost projects are going to have a higher floor on what they can charge on the credits in order to make the project viable than a lower cost project. But that doesn't necessarily mean that there's a different ceiling on those prices. I think the ceiling on the prices, or the market price, is going to be determined by the market.
Yep. Although there is a debate around the future and where prices will settle in terms of cost plus versus otherwise. There's a question on debt instruments for carbon projects. Do they benefit from longer grace periods compared to other sectors? Or is that taken into consideration? I would say in our experience, in terms of typical debt, from a local bank or private credit fund, no. I think it's generally treated the same as other sectors. Now, when you look at the carbon finance, and I should say we use the term carbon finance specifically to mean repayment in carbon credits, which obviously could be debt, could be equity, but that's sort of how the terminology that we've landed on. For carbon finance, that often is playing essentially a senior debt role, right? So if you're, if you're the carbon streamer, you're playing an equity-like position, but actually first in that waterfall to receive repayment in carbon credits. And so we usually see that role as very debt-like. And that typically does have obviously very different features in terms of expectations for repayment, which would include the equivalent of grace periods. So that the carbon finance instruments tend to be much more flexible and obviously designed to support carbon specific projects because there is a strategic interest in the delivery of those credits. We've seen very little traditional debt going into projects that are primarily carbon revenues to date, at least in the markets that we work in. Say a little bit different in maybe Latin America, where you have offtake agreements, but that's much less common generally.
Great. Should we move on to the next section, just in the interest of time?
Yeah, happy to. And for any questions that we're not answering here, we'll also keep answering in the chat, and we have a longer Q&A at the end of this. So no worries. And if you think we've forgotten, feel free to just drop it in again. Wonderful. So the next section, and go ahead, Makari, and just full screen that.
Oh, is it not full screen? Is it
not for me?
Oh, okay. Here, wait. Let me try again.
I'm seeing the Q&A slide. Oh, I'm still seeing the Q&A slide. Hello? Can you hear me okay? Is it my internet?
I think we may have momentarily lost Makari. Let's just wait a moment or two. He rejoins.
We've got better internet in Senegal than London.
Maybe in the meantime, we can pick up a couple of the other questions. There are quite a lot in the Q&A.
Yeah, happy to. So I saw there was a question around returns for debt and equity investors and timelines, and is there patient capital that can understand the long time until break even? So we'll go a bit deeper. We'll go a bit deeper in the section around the investor landscape, around specifically what are the types of investors, what kind of returns are they looking for, what's their timeline. So we'll get a bit deeper there, but typically for equity investors, we see expectations anywhere from, like on a commercial side, anywhere from, let's say 15 to 20% IRR, which of course, on a project that will take longer to start issuing credits, starts to be tricky with just the time value of money. For debt, I would say varies a lot more. Anything from low double digits to similar to equity, depending on the geography and depending on the type of collateral and security that the project is able to offer, which we'll also get into a bit more. Actually, I can just go ahead and share directly. Let's see. All right, let me know if you're seeing this okay.
Yeah, we see that fine.
Cool. And Makari's rejoining. So yeah, so this section is really around pricing and trading risks in financial markets, and implications for projects as they're raising capital. So project finance, in financial markets basically are a way for pricing and trading risk. And the very basic concept is that taking risk needs to be compensated with receiving higher returns. Now, there's sometimes a bit of a misconception that risk is inherently bad, but actually it's also the source of returns, and different types of investors as well as other entities are set up to take different levels of risk and to receive different levels of return. Some are looking for that low risk, low return opportunity, Others are looking for that high risk, high return opportunity. And so as you're thinking about the capital raise process, knowing who you're talking to, what their expectations, what their requirements are, is really important. And obviously, we'd all like to find those opportunities that are high return, low risk, in an efficient market that does not exist. But of course, investors are looking for opportunities that they believe are in that upper left-hand quadrant, where they are able to better assess risk and therefore receive some premium. And on commercial investor side, obviously the lower right-hand corner is what you want to avoid, where you are taking high risk but not being properly compensated. Now, there are, of course, others who are interested in playing in that bottom right quadrant, who have concessional capital that don't need to hit market returns if that higher risk is also associated with a different type of impact that is not fully reflected in the financial returns of a project. And Makari, if you're back, if you want to swap screen share quickly. And then one key term just to introduce here is the risk-free rate. And so this is that benchmark against which deals would be measured. This is basically what's the return in the hypothetical situation of making an investment with zero risk of loss. And this is typically benchmarked as short-term government debt, right? So you buy a treasury bill from the US, you're going to get repaid, and there is an interest rate. It's low, but it's not zero. And so that's the sort of theoretical minimum in terms of that risk return band. Next slide, please.
Does my screen look right now?
Yep, it's great.
Okay.
So there's a number of common risks that are priced into any investment, and this this has nothing to do with carbon. This is consistent across all project types. And so you can think about this as building up from that risk-free rate and adding on the price of other risks that may be inherent in that project. So some of the common ones include country risk, currency risk, particularly where there are local currency revenues. Now, obviously in carbon projects, this is a distinct advantage, right? You're typically selling carbon credits in US dollars or another hard currency. And so you don't have that mix match in the currency of your financing and the currency of your revenues, which is typically what this risk measures. Counterparty or credit risk is another one. Again, when you enter into an offtake agreement or have other agreements with buyers, that's one of the counterparties that you've taken that risk away from. There's obviously a premium for anything early stage if you don't have revenues yet. There's a premium for any unproven technology, business model risk, though a lot of the carbon generally falls into that category. Regulatory risks, so things like carbon rights and also other project-specific licensing. So obviously it's not just carbon rights, but also other licenses to operate on particular land. There's also a premium for illiquidity and exit risk that is not always thought about. So this is essentially the risk that the investor has taken in not knowing how and when that funding is coming back, right? And so, in the case of debt, obviously it's very clear. You're getting interest rates, you have cash repayments. There's a set way that is repaid. In the case of equity, you need to find some liquidation event, right? There needs to be a sale or another way to bring that capital back or dividends. And so just that uncertainty around the exit risk in the case that you're keeping your money in the investment for a long time also requires a premium. And then finally, time horizon, of course, matters. And this is not just the time for funding to come back, but actually the uncertainty associated with predicting future events and the compensation for simply not having information about the future. Next slide. For carbon projects specifically, there are, of course, their own set of risks. And I won't go through all of this because I think these will also look familiar to you all. But this is an excerpt from the Carbon Finance Playbook, which goes into much more detail around how to mitigate each of these risks. But I think what's helpful here is just to get into the head of the investor and some of the things that they will be specifically looking at in the diligence process. and it can help you anticipate some of the questions that they'll have. We think about this in a couple of buckets. Obviously, country risk. So this has nothing to do with what with the things that the project is doing, things in your control, but simply characteristics of any investment in that country. Obviously, within the carbon market specifically, you're looking at certainty around price and demand. And then finally, on the project side, you're looking at execution risks, so simply how the project is run and managed over a long period of time. And then separately, this question of carbon credit delivery risks and the many reasons that could prevent credits from being issued, even if the project implementation is going well. Next slide. So I wanted to spend just a bit of time on this because, again, there's all projects have risks. They can't all be reduced. And so there are, the question is really, what do we do? And the way that we think about this is you can do three things, right? First, you can mitigate the risk. So reducing the likelihood that it happens in the first place and or reducing the impact that that risk has if and when it materializes. And obviously you want to do everything you can to mitigate risks within your scope of control. So doing things like piloting, phasing projects to demonstrate success at a smaller scale, working through the relationships and practical aspects of a project implementation before scaling up, that can help to mitigate some risks. Contracted offtake agreements we've talked about, so taking out some of the market risk inherent in these projects by knowing, at least for a portion of credits, who's going to buy them, how many do they want, what's the price. And then, of course, from a process standpoint, effective engagement with local, state, national government, and strong processes for community engagement, particularly adhering to free, prior, and informed consent and IFC performance standards, which can reduce the risk of disruption over the long term by ensuring that those relationships are well managed and incentives are aligned. So reducing the risk of things going wrong. But obviously, even after you've done that, there will be residual risk in the project. And so you can do two things. You can allocate it amongst the partners within the deal, or you can offload it to a third party outside of the deal at a cost. Allocation requires changes in the economics of the deal, right? So who's responsible for what and how are they being compensated for that risk that they're taking? Transfer actually increases, obviously, the costs because you're paying someone else to take on that risk. So in terms of risk allocation within the deal, this involves things like enhanced collateral and security that the developer is able to offer to the investor so that in the case something goes wrong, they know they're able to be compensated. That can also include guarantees provided by the parent company, again, to reduce investor risk. Of course, that diminishes the non-recourse aspect of the project, but is often necessary. And then looking at things like milestone-based payments, right? So you're not getting $20 million up front. You're getting disbursements of that funding on a milestone basis as the project is de-risked. And the general principle for risk allocation, of course, is the risk should be allocated to the party that is best able to manage it, both in terms of preventing it from happening, but also managing it in the case that the risk does manifest. And then finally, of course, risk can be transferred to a third party. Often this is through political risk insurance, physical risk insurance that can cover specific issues that the project that are outside of the project's control. So for political risk insurance, some common points of coverage include things like business disruption due to political violence, expropriation, breach of contract in the case that the government is a counterparty in the deal. And then for physical risk, of course, this is the product broadly available in the market, not just for carbon, but in the case of a fire, of a typhoon, of drought, being able to have that coverage that allows you to reinvest in the project and rebuild that asset. And of course, in thinking about insurance, this is not only products that the developer may purchase, but can also be purchased by others in the deal. And the question is just the trade-off in terms of the cost and the requirements, of course, that the investor will place on the project in terms of maintaining certain insurance. That
Great.
concludes the risk section. And now we'll talk about investor landscape.
Thanks, Kate. All right. So who are the investors that are actually going to be investing in these carbon projects? We typically think about it in kind of two broad categories. There are the carbon specialist investors, and then there are the generalist investors. The carbon specialists, these are going to be the ones that have a lot of carbon expertise, might already have quite a large portfolio of carbon projects, so they understand the economics of carbon projects. They potentially have data from other projects they've looked at that they can use to kind of benchmark against your project, both in terms of like the operational metrics, but also cost metrics. They'll have very clear views on pricing, for instance. And one of the big differentiators is that a lot of the carbon specialist investors, today at least, maybe not in the future, but today a lot of those investors are actually looking for actual carbon to basically be repaid in carbon credits, so carbon finance, rather than receiving like a direct financial return from a project. And the kind of we'll go through a lot of the kind of investor categories or investor types, but this is typically like the carbon funds that are basically building portfolios of carbon credits. On the other side, you have the generalist investors, which can kind of be thought of as like most other people. So these are, existing investors who, maybe there are some that are focused on climate or focused on green assets, but they're not going to be focused, exclusively on carbon. We'll be looking at some of the kind of broader impacts or outcomes, let's say if they're impact investors, and are likely going to prioritize financial returns over carbon-specific metrics. So a lot of these investors, let's say, the DFIs or banks or impact investors, they are looking for projects, at least today, again, this might change in the future, but today they're looking for projects that have traditional revenue streams alongside carbon revenues. So things like timber or agriculture or energy, if we're talking about, on the engineered side. And a lot of these investors, they're kind of on a spectrum between being okay underwriting investments to those carbon revenues if they're incorporated into like a financial model, to taking a financial model and just deleting out the carbon revenues. But oftentimes they will view carbon as kind of an upside, and they'll want their investment to make sense without carbon incorporated. Diving down into the more specific types of investors, I think it's helpful to just quickly walk through this table, which outlines a lot of the investors that you might come across in your fundraising journey. So starting from the top, the first type is private equity firms. These are set up as kind of typical funds, which means that they raise money from other investors, and then they have a set time horizon within which they need to deploy that capital. So typically for private equity, that would be 7 to 10 years or so. They have a medium to high risk tolerance, but also very high return potential, and they're investing equity into projects, hence the name private equity. The next one, venture capital. This is probably going to be more likely for you to raise money from venture capital, and this would be kind of at the top co level or hold co level that Kate was describing earlier. Similar to private equity, these are set up as fund structures. They'd have a set duration within which they need to invest and exit their investments. But unlike private equity, they're raising from family offices and high net worth individuals more so than the institutional investors. They have a even higher risk tolerance than private equity, but that comes with a higher return requirement. Next, we have the development finance institutions. These are basically the kind of investment arms of governments, let's say, of kind of like foreign assistance. So the money that they are deploying comes from the governments, almost not exclusively from governments. There are some DFIs that will actually raise institutional money from other investors, but the money is primarily going to be public money, which means it's a little bit more flexible. It has longer time horizons. And most of these DFIs have kind of a stated mission to be catalytic and to invest in areas where other investors aren't willing to invest. But oftentimes we see that the returns that they require and their risk tolerance isn't actually as high as they claim it to be, and oftentimes they are actually requiring something very close to market rate returns. But DFIs are a great option. They are kind of coming along their journey towards carbon, but a lot of them are still focused more on traditional businesses, but they're willing to invest into like a forestry business that has carbon or an agriculture project that has carbon. Commercial banks, they are, they're set up as corporations or as companies. Typically, they would be investing through loans. The important to know, maybe DFIs can do either loans or equity. The commercial banks would typically be doing loans. They get their funding from, people like you and I who are depositing in those banks or potentially raising it from financial markets. They have very low risk, but also fairly low return. They are less comfortable with carbon markets. There have been a few commercial banks, I think Standard Bank, maybe Standard Charter. Like there's a couple banks like in the like Africa context, for instance, that have made some investments into carbon projects, but they're fairly early on in that journey. Carbon funds are probably the most important investors on this list for carbon project developers. They oftentimes will have a fund structure, so they'll raise money similar to like a venture capital fund from high net worths, family offices, institutional investors, and then they will have a set amount of time where they're going to deploy that capital and exit those investments. They're oftentimes building a portfolio of carbon credits that then they're going to sell on to off-takers. They know a lot about the carbon markets. They also have fairly high risk tolerance, but fairly high return thresholds. And so, they're one of the few investors that's willing to come in early and fund carbon projects that are maybe pre-verification or pre-registration. Family offices can be a great source of capital because they're very flexible. These are basically high net worth individuals that are investing their own money, so they're not beholden to any other investors. So they can kind of choose what they want to invest in and how they want those instruments to look. However, they're fairly difficult to find. They are not as kind of there's not as much public information on them as there is about a lot of these other investors. And so, this is can be more of like a network search to find these investors, but they can be, if you can get one that's very closely aligned with your project, that can be a really good source of capital. Corporates can also invest into projects, and this can go a couple of different ways. In some cases, there are actual, corporates that are willing to do carbon finance. So, they want to offtake credits for their own internal net zero, targets, and they're willing to invest early stage in pre-purchasing or streaming agreements. You see a lot of big energy companies that are interested in doing this. Total, Eni, some of the oil and gas majors that will come in early. They have a fairly high risk tolerance. And then I'd say on the other side of the corporates, you have like the strategic investors that would be interested in the other business models that you have. So forestry companies or agriculture companies that are interested in investing more like debt and equity into carbon projects. The last two, maybe I'll group together. These are the two kind of main sources of capital for grants. So foundations and let's say other NGOs, obviously very low cost of capital. As Kate mentioned, I think important to kind of try to raise as much money as possible as you can from the donors. But there's not as much capital available, frankly, from donors to fund, especially large projects or large ticket sizes. And those could be, they could be the private sector foundations, the NGOs, or they could be government donors, such as the, foreign assistance departments within governments. We've done kind of a mapping of various different investors across a couple different dimensions, which we've shown here. This is by no means exhaustive and will also depend on the project type that you have, but just to go through a few takeaways from this. So the rows here look at the different business models. So the top row, carbon as the core business model, so all or most of the revenues coming from carbon. The bottom being business models that are not focused on carbon. And then in the middle, you kind of have investors that could potentially do both. And then along the columns, you've got the different types of instruments that they deploy. So for pure carbon projects across the top row, the interesting thing to note here is that there are, a number of NGOs and other corporates that might provide grants, and then there are a lot of organizations that can provide carbon finance, but there's not that much in the middle, especially with concessional financing, debt for carbon projects. As Kate was mentioning, there's a very small group of financial institutions that are willing to come in and make those investments, hopefully increasing in the future, but that's a major gap in the market. And then the other thing to note is that if you incorporate other revenue streams, so maybe non-core business, or at least a balance between carbon and other revenues, you open up a much wider set of investors. You can see all the investors in the maybe invest in either or carbon non-core that are able to provide debt and equity and concessional financing to projects. As you start on your kind of fundraising journey, the most important thing about fundraising more broadly is really building relationships and trust with investors. At the end of the day, a lot of people think that it just comes down to like crunching the numbers, which is an important part of investing and raising capital. But a huge portion of it is about relationships and, finding an investor that you click with and really building trust with those investors. So how do you go about doing that? Well, the first thing is to develop a really strong network. So maybe you have past investors that you've worked with, maybe you know people who've worked with investors or raised capital. Cultivate that network and try to expand it as much as possible. Be collaborative with investors. So in some cases, you can kind of establish long-term communication channels or even partnerships with investors where you're almost co-designing a project. That can be very attractive and can mean that you're kind of bringing an investor along the journey so that they're not having to start from scratch when they first meet you and you're raising capital. Along a similar line, engage with investors early and engage with them often. So, even in the early stages, maybe you're not even quite ready to raise capital yet. Start having conversations with investors, start actually building those relationships and provide them regular updates so that they, again, are kind of coming along that journey with you. Develop a track record. So, if you're coming from, maybe you're new to carbon, but maybe you're coming from another industry or have done other projects in the past, make sure that you can demonstrate that track record and demonstrate that you're going to be a reliable custodian of these investors' money. Facilitate due diligence. This is kind of once you're actually in the process of raising capital from investor, but the easier you can make that whole due diligence process and risk assessment process for an investor, the better. So, we'll talk in a couple slides on data rooms, but maintaining a very comprehensive and organized and easy to access data room, sharing project information, responding quickly to due diligence requests. These are things that make it easy on an investor and just make them want to do a deal more and make them, reduces the cost basically on their side so that they're more willing to work with you. And then finally, be transparent. Investors are looking at lots of projects. They can tell when someone is, fudging the numbers or making things up. And so be honest, be transparent, clearly communicate the risks, clearly communicate your plan to solve those risks. That's a much better path because ultimately down the line, those things are going to come out and it's going to become a problem. So the more you can be transparent and share information, the better. Investors follow, and this varies from investor to investor, but typically they follow a fairly structured due diligence and investment evaluation process. And that oftentimes starts with an initial screen. So they might review your pitch deck, review a project teaser, have an initial call with you and the management team. Then that would lead to, if they're interested, that would lead to a preliminary due diligence. You'll sign an NDA, you'll share a lot more information. This is when an investor would typically get access to that data room, which we'll talk about. They'll want to do a lot more, interviews with the management team and yourselves. And then they will put together a kind of preliminary investment memo that will go to their investment committee. The investment committee is basically the group within the investor that makes decisions on investments, and they'll make an initial decision on whether to proceed with allocating more resources to due diligencing you and evaluating you and your project. And at this stage, you might also sign a term sheet, which is typically kind of a non-binding overview of what the investment could look like. And then once that's happened, then you'll go into a kind of formal due diligence process, which can be quite long. It can be anywhere from a few months to, in the case of the DFIs, it might take a year and a half to go through this whole process. But the investors will continue to look through your materials. They'll submit questions, which you'll have to answer. They'll probably do site visits. They might contract with other technical experts or consultants to come in and actually evaluate the project. Auditors. Both on the carbon side and on the financial side. Through this process, you'll negotiate and ultimately sign a kind of official term sheet, and they will put together an investment memo, which then goes to their investment committee. And that investment committee will ultimately make the final decision on whether to proceed with the investment or not. And then there's oftentimes a kind of final due diligence step where they'll just confirm everything that they learned through the rest of the process. And if that goes well, if you kind of pass all of that, red flags, all of that, then you'll go to the final step, which is transaction execution, where you will do a final negotiation and sign the actual contracts and legal documents behind the investment. And then you'll receive the funding. And then, the investors will basically go into their kind of monitoring phase. You might not receive all of that. It's actually quite likely that you won't receive all of that funding in one lump sum. Oftentimes, especially for project finance, investors would like to have milestones, and they'll disperse funding according to those milestones over a series of a few years to make sure that they're mitigating their risks. So for the data room, a data room is really important because the more comprehensive it is, the easier it is for investors to access and to navigate. The less you are going to have to, go back and forth with investors and answer questions and send, ad hoc information and answer ad hoc requests. So it makes it easier on you. It also makes it easier on the investor. If you make a really good data room, not only does it reflect well on you as the project developer in terms of your organization and preparation, but it also just means that an investor can much more quickly go through and have their team review all the information as opposed to needing to wait to ask you for things. So a good data room will be hosted on some kind of secure online file sharing platform that you can basically send the link to investors so that they can easily access it. And it should also have some kind of a guide. It should be well organized from a file structure standpoint, but it should also have like a guide for investors on where to find specific things. And within that data room, there's a lot of information that you could include, and this will vary depending on the project, but we've kind of laid out a few of the core buckets here. Marketing materials, so these are kind of overviews of your project, a teaser and a pitch deck, legal documentation behind your company, your corporate structure. On the financial side, you'll need audited historical financials, ideally the 3 financial statements that we walked through earlier. On the carbon side, they'll want to see, what methodologies you're using, what carbon curves you're using, shapefiles for the project, in case they want to do their own analyses, and then, like a full-blown, ideally pre-feasibility, but ideally a full-blown feasibility study that shows your carbon calculations. On the social side, a lot of investors will want to see, that you followed FPIC processes when communicating with communities, social baselines, impact assessments. On the commercial side, if you have an existing business, who are your customers? And they might want to actually, call those customers as reference checks. And then finally, an organizational chart showing the key personnel, and then maybe also profiles or resumes for those personnel. And finally, there are certain green and red flags that investors are looking for, which are also important for you to keep an eye on. So green flags would be basically good things that investors see in projects. So this would be like, responsiveness to their requests, transparency with information, having a proof of concept from maybe a pilot project that you did that can give some preliminary data and information and results, having a robust MRV frameworks, having a scalable project that meets their kind of minimum investment criteria, having strong partners, the risk mitigation strategies that Kate mentioned earlier. Strong management team, one of the most important things, and especially like a track record of that management team in managing projects or companies in the past. Secure land tenure, which could be something with the central government, or could be something with a local government or community, or both. And then government approval and licenses. So whatever you need approvals wise, whether it's, again, if you're doing like an infrastructure project or a forestry project, you might need to get approvals from those ministries or departments. But then you also likely will need some kind of a license that gives you the rights to conduct a carbon project and export carbon credits, increasingly common in countries. And then on the red flag side, lack of clarity around the business case or the roadmap, disorganization and lack of coordination, especially with respect to like disorganized, materials that you're sending across or disorganized data room, low fidelity or low quality projections of the carbon impact and forward carbon curves. So basically, not having robust feasibility assessments, regulatory uncertainties in your country, lack of buy-in from local stakeholders like communities, unproven technologies. If you're doing something that's incorporating new technology in the engineered space, a lot of these types of investors don't want to take on a ton of technology risk. Lack of commercial or technical expertise on your team, and then weak risk management. So not having, mitigated the risks or not having transferred or allocated the risks effectively, and then very small projects that don't meet their investment criteria. So before we get into another Q&A, I do want to put up another poll here and just get responses from the group on which of these or other red flags have you encountered, and basically, what did you do to overcome these red flags if you were able to? So we'll just take a couple minutes to do this poll. All right, we've got some responses coming in. So biodiversity metrics, yeah, that was the first one. As Kate had mentioned earlier, co-benefits are really important for carbon projects. So if you're, if you are showing, maybe great carbon outcomes, but bad biodiversity outcomes or negative biodiversity outcomes or social outcomes, that's a big red flag for investors these days who are very careful with that. Yeah, organization, regulatory uncertainties. Regulatory uncertainties, again, is maybe a shorter term thing. I think right now we're in this phase where a lot of, especially emerging markets governments, are doing their first carbon markets regulation, and there's oftentimes a bit of growing pains with respect to those getting implemented. So hopefully a lot of that will become a bit more streamlined in the future, but it's definitely a big risk right now. And then as far as the mitigants, yeah, discussion with governments, very important to have strong communication with governments and open lines of communication and good relationships. That will make project development so much easier, getting approvals, getting corresponding adjustments if you're doing sales into Article 6 markets. Yeah, communication, validating assumptions, bringing in external third parties that might be experts to do, if you don't have that expertise in-house, to do carbon feasibility studies, to do your GIS work, to, audit, on the financial side, like bringing in external accounting firms and auditors. All these things can be very helpful in mitigating some of these risks and red flags. Great. With that, let's turn to a Q&A, and I'll flip back to the questions as well. Kate, was there anything you wanted to address right now?
No, we're just going to jump into the Q&A. We've got a number of good questions. Again, some of which have answered in chat, but we'll talk through some now. So, question on the topic of prices. Big buyers procure offtakes through RFPs, which typically ask you to specify your price curve up front. There's an inherent information advantage that buyers have, which impacts price discovery dynamics. How would you advise developers to navigate this tension to stay competitive in RFPs, but also optimizing for project revenues to deliver impact on the ground? Great question. And indeed, many buyers of credits are still working through RFP processes. where they may have more information about the market than you do. And price discovery is one of the known challenges in carbon markets. Most sales happen over the counter, so not on an exchange. The information is not publicly available. And so it can be really hard to tell what's the fair price of a credit for my project. I'd say our advice is typically, obviously know the market as best you can, getting to have a personal network with other developers and collecting as much data as you can from public announcements, from conversations around where prices are, in addition to some of these industry and reports such as Makari shared earlier with some of the aggregated prices. So know as much as you can going in around what the market price might be. But, for buyers, the real question for them is they want to know, why should your credits cost what they do, not just what's the market price. And so they are often thinking from more of that cost plus basis, right? So what are your costs of productions? Why do communities require the certain amount based on your theory of change? How much returns do investors require? And based on that, how much return do you require? And based on that, what's the price? And so, rather than saying, here's what someone else sold it for, actually doing that bottom up tends to be better valued. And, to what Makari was saying, just that transparency and thinking about key project questions. There's another really good question around, I think I'm interpreting this correctly, but how would you think about carbon equity? So is it % of revenues returning as payments to project participants, farmers, others? How do you think about, I think this is equity from a equity and justice rather than a equity financing instrument. So I think just to flag, we do have a chapter just about benefit sharing in the Carbon Finance Playbook that could be helpful. We think about equity in projects in 3 ways. And there's often a lot of focus on what is that, percent, the correct percent, but actually equally important is the process of arriving at those terms. So we think about, was it a fair process? Are the terms fair? And then are the outcomes fair in terms of actually implementing the agreement in practice? So how funds are distributed, who's involved in the governance decisions and such. In thinking about this from a project finance perspective, one of the things that we typically advise and like to see is project costs should obviously include addressing the opportunity costs of project participants like farmers or others who are taking risk in the project through changing their behavior, performing certain role in the project. And so making sure that is built, that there is that downside protection for them by including them in the costs, right, which are going to come out first. And then balancing that as well with upside participation in the case of excess returns, right? If the price of carbon, triples, that increase in value should not only go to investors, but also to everyone who's participating and taking risk in that project. So balancing that risk protection with the upside participation is generally best practice.
Maybe just,
and then there was I
was just going to respond to a question around project size and viability. Yeah, I mean, the challenge with size is that a lot of the costs are fixed. So there was a question around, does a small project have to go through the same process? And they really do. If you want to get certified with one of the big carbon standards, like if you're generating, 10,000 credits, I think was like one of the numbers used versus 10 million credits, like you still have to go through the whole registration process. So that's why, as a project gets larger, the unit economics typically improve because there are a lot of kind of upfront fixed costs. So, I wouldn't say there's necessarily like an exact value at which point things stop making sense. It depends very much on the type of project, the geography that you're in, all of that. But larger typically will have slightly better unit economics.
Yep, agreed. As well as not just the cost of certification, but also small investments typically take just as much time and effort as big investments from the investor's perspective. So there is always a pressure toward larger tickets, and from a buyer's perspective, the same intuition applies. Another question we had was, what do you think are the biggest issues resulting in that are causing these gaps. For example, in mainstream banks not offering debt to carbon projects, what can be done through policy or otherwise. I think the main challenge is just the lack of track record and the small size of the sector, right? So for anyone who's underwriting a debt transaction, what they want to see is, and even equity is, 20 other deals that look really similar that we know what the returns are, right? And that helps you get comfortable with what is the actual risk and what can I expect. And we're just not at that point in the development of the sector yet. And so getting some of these first deals done, building that track record in sort of a big picture is really what is needed. In the meantime, obviously, it's all about de-risking. So offtake agreements, collateral, et cetera, specifically for bringing debt in. And then, of course, guarantees are an important tool, which can be offered through development finance institutions or others to guarantee for debt providers as sort of an interim.
Yeah,
there's
I
also a
would
good
say
question. Yeah, go ahead.
on that one, I was just also going to say, investor education. Like one of the big things we try to do is educate these traditional investors on carbon markets to help them better equip them to assess the risk and assess the project. So, as project developers, that's also something you can do. I mean, it might be a long journey to get a bank or someone like that to invest in a project, but if you give them enough time and enough information, then that will help them.
Yep, and size as well.
Yeah.
The final question I'll answer here, which I did answer in chat, but I think is a really good one, and then we'll save the rest for the final Q&A. But there was a question of, okay, you've got a carbon streamer in a deal, you have another off-taker in a deal, who gets priority in terms of credits being issued? So obviously it depends on how the deal is structured. As a general principle, typically the entities that are actually providing upfront capital are going to be senior, right? So if you have a carbon streamer, they're going to require that the first X% of credits above a certain, including a certain minimum if the project underdelivers, goes to them, right? So those credits are going to the investor before anything is even coming to the SPV. And so if the offtake agreement is not tied to the carbon stream, it's simply a sale of the project's own credits, those will inherently be lower or second in that waterfall to the investor. Now, we have sometimes seen, for some carbon streamers, they don't want to retire credits themselves. They're doing this in order to sell it to others. And so they can do as well a back-to-back agreement with an off-taker, in which case, they're putting in the upfront capital and they have an offtake agreement just sitting behind that. And so in that case, they're essentially sitting equally and you don't have that conflict. And for them, it obviously takes out the risk because they already have a buyer, obviously caps the upside in some ways, but can be a really nice deal structure as well. And generally, like there is a strategy around, you don't want to oversell credits in advance because you may have underproduction, you may have delays. And so for most carbon streamers or other upfront buyers, part of the reason they don't want to take more than half of the project's credits is because if it underdelivers, they have that buffer. But if you are selling your credits in advance, you may have that pressure because they will be coming after that senior investor, and so leaving enough buffer ensures that you're not triggering clauses in the case of underdelivery.
All right. Amazingly, we're pretty much right on time. So, Kate, next section, negotiating investment terms.
Perfect. Yeah, so we have two more sections left, and then we'll end with a final Q&A. So this is around investment terms specifically, and then we'll do a couple of case studies at the end. So we will look at typical investment terms for traditional financing instruments and carbon financing instruments, the same way that we went through them at the beginning. And this will be mostly around definitions, but also the implications of this for the project developer. So for debt, there are a few key terms. One is obviously, what is the interest rate of that debt? Higher increased project costs, lower decreased project costs. and that's simply the the amount that you're paying on the principal throughout the duration of the loan. Obviously, the principal is the amount that you're paying. And then finally, there are often a number of different covenants, and some of these are specific to debt, some of these are not, but will have significant implications for how the project can raise additional capital and how events of default are defined and triggered. So some common types of covenants are financial covenants. So you will have a defined debt service coverage ratio that ensures that the borrower has enough cash to cover its debt repayments. And if you trigger that, then it will, then you're going into a default event. Other financial covenants are interest coverage ratio. So this is a measure that looks at how much buffer do you have specifically for interest payments. We'll also look at leverage ratio. So how much debt, limiting how much debt the company can take on. So when you take debt, you will likely have limitations on your ability to take additional debt without approval of that first debt provider. You may also look at loan to value ratio. So how much collateral do you have compared to the loan value? And then you may look at liquidity ratio as well. So how much cash do you have to cover your short-term obligations? There are also non-financial covenants. So basic affirmative covenants, and this applies not just to debt, but otherwise other instruments as well. So maintain accurate financial statements, maintain insurance coverage, tax and legal compliance, environmental and social safeguards, and then use of proceeds. How you can actually use that funding for debt is typically specified, as opposed to equity, which which typically does not have quite as strict of limitations. There are also negative covenants. So I mentioned things like can't take on additional debt without approval, right, to prevent the company or project from being over-levered. There may be limitations on distributions to equity holders. So no dividends until the debt is repaid. There will be limitations on the ability to sell assets or transfer collateral, right? Because the pledged assets need to remain in place throughout the life of the loan. And then obviously restrictions on change of control. And then finally, information covenants are typically included. So you're going to request monthly, quarterly reports, look at budget versus actual, and then of course be required to notify in the case of defaults, material events, litigation, and such. And these are all built into the contracts. For equity, the common terms relate to what's the ownership stake, right? So you are receiving a certain amount of cash, and what is the share of ownership that you are receiving in exchange for that investment. This obviously has implications for governance and also for the economics of the project and the returns that you're receiving. And 30% of the economics doesn't necessarily mean 30% of governance, right? You can negotiate those a little bit differently as well. Equity investors are also looking at return on investment, which will, has implications for how they expect the company to grow and some decisions that may be made. And finally, equity investors are really thinking a lot about the exit strategy, right? Again, debt is straightforward. You're getting interest payments. You've got a timeline for repaying the principal. Equity can be much more ambiguous, and so often investors will want to build equity events, exit events into that structure. So you can use things like redemption rights that require the company to buy back shares at a certain time, or put options, which are very similar, but would require a third party to buy those shares back at a certain time. And this is often especially used in the case that the investor is a fund, right, which has often a 10-year life, and so they have to have exits at a certain time. And so building those events in can help them get comfortable with the deal. For minority equity investors, they're often looking for additional protections. So things like drag along and tag along rights. So what happens if the majority investor sells? From the majority investor side, they obviously want to make sure that the minority investor also goes along so that no one's blocking the sale. At the same time, the minority investor wants tag-along rights because they don't want to be left behind if the majority of the business is being sold elsewhere and they would like to exit at the same terms. And then there may be specific rights included that are tied to IPOs or other liquidity events. And there may be requirements for preferred return or specific liquidity preferences. So much of the structuring will be the equity investor thinking about, how do I eventually exit this deal? And then finally, mezzanine, again, is a pretty broad category. So has characteristics of debt, has characteristics of equity, can be very flexible in terms of structure. The key things that the mezzanine investor will be looking at is obviously the seniority. So this sits somewhere between the debt and equity position, and as such has higher interest rates than debt because it is taking on more risk. And then often there is a convertibility feature. So the ability for, if this is usually a debt product, for that debt to convert into an equity position under certain circumstances, and that can help align interest as the project moves forward. And then finally, another feature that's often used in mezzanine is payment in kind. So one of the issues we talked about for debt is obviously can take time for cash flows to start being issued or to start coming in. And so what do you do in the interim? And so mezzanine debt very often has those interest payments built in, but instead of having to pay them in cash, it just becomes additional debt or additional equity. And so there's no immediate obligation for the project during those critical early years. So it's not a grace period because there is interest being charged, but it is not interest in cash today, which can be helpful. And then similarly, we can look at the 4 carbon finance instruments that we mentioned. Again, carbon finance just meaning returns are in carbon, but have features of both debt and equity. In addition to some of the terms mentioned on the previous slide, for pre-purchase agreement, we're obviously looking at what's the price that you're selling at. This doesn't have to be a flat price, and there are many ways of setting that benchmark, right? It can be stepped, it can be increasing at a %, it can be benchmarked to an external index, but there needs to be a price included and a volume. And then of course a schedule for when those credits are delivered. For a streaming agreement, similarly, we have what's the upfront payment being provided, and we have what is the % of credits being delivered. Using the project projection, that gives us an estimated volume, and from that you can produce an implied price. It is different from the pre-purchase in that it's not actually a set price and set volume. There's greater flexibility in those variables based on what actually happens in the project. And then of course we need to know the actual duration for that agreement. On offtake, similarly, what's the price, what's the volume, what's the delivery timeline? And finally, for brokerage agreement, the key term is going to be what's the commission. So % of that carbon revenue that they will receive as they sell credits. So one of the biggest issue typically when negotiating terms on a carbon project is figuring out what happens in the case that the project does not deliver as many credits as they thought they were going to. Now, there can be extreme versions of this, right? When you have complete project failure or non-delivery for a number of reasons, or you can have simply the situation where there are delays, where maybe you have fewer credits than expected in a certain year, and so needing to think through what happens in those situations. These are obviously not every potential scenario, but some common things that we see built into contracts. So obviously you can terminate the contract, but there are still consequences associated with that. Most typically the buyer wants the carbon credits, right? They don't really want that. They're not looking for the financial return. They're not looking for cash. They just want the type of credit that they bought. And so usually the first thing that they'll ask for is some sort of replacement for that credit. That could be from another project from the same developer. It could be a requirement to buy those credits on the spot market. And there will be obviously criteria for what type of credits qualify. and usually they'll be looking for very similar characteristics. And then in the case where it is not possible to provide a replacement credit, there can be obviously a cash penalty, so some sort of repayment for the cash that the developer, that the investor has already put into the project. There can also be an option to convert to equity. So if there is some value in the project, they could change from, they could convert their position into an equity position. Again, this may or may not actually be aligned with the interests of the investor, but it is something that could be offered. And then, of course, there will be a need for step-in rights, so that the investor is able to address operational issues that arise in the case of severe non-performance. And then finally, regardless of the specific instrument being used, investment agreements are likely to require several standard requirements and clauses. Now, some of these are more debt specific, more equity specific, but I think are worth worth talking to. So from a governance perspective, you're looking at voting rights, right? So how much power does each stakeholder get when voting on key project decisions, and what are those decisions that require a vote? Information rights we discussed. So investors will have will be required, or will obligate the project developer to provide certain information. It can be on a quarterly basis or semi-annually. And then, of course, who sits on the board? Is this a observer seat? Is this a voting seat? And which investors actually are able to have that? Security is a bit more complicated. So the big area here is around the collateral that's being offered, and this includes a couple different categories of collateral typically. So it could include tangible assets, so land, physical commodities, vehicles, equipment. Now, the challenge here, of course, is for most carbon projects in emerging markets, there's not private land ownership. Sometimes there is, and that can be helpful, but it's often either not land that can actually be used as collateral, and or the enforcement of collateral is very difficult, right? If you're talking about the enforcement is taking away, small landholders' land, like that just doesn't work in practice, and so it's not a practical and incredible means of collateral. Similarly, even for some of the physical assets, the actual sale of that in certain markets can be very difficult. What's the actual value? Who are you really going to sell it to? And so in many cases, the tangible assets can be a little bit more challenging for carbon projects. There are also obviously intangible assets, typically contractual collateral. So your offtake agreements with buyers, your receivables, license permits, insurance proceeds. Obviously, the challenge here is also around enforceability and valuation of those intangible assets. But these contracts can be assigned, and you can use an escrow account as well to ensure, for example, that payments from buyers will indeed go to that investor before they go to the project if there are issues. A second area within security that is quite common, as mentioned, is the guarantee from the parent company, which is a form of credit enhancement. Obviously, this is only as good as the creditworthiness of that parent company. So in many cases, if the parent itself is a startup or you have a shell company sitting somewhere, that again will not be a very, very credible guarantee. And finally, typically there would be a pledge of equity, which needs to be perfected and actually able to be registered locally. And this essentially allows takeover of the SPV in the event of default. Other rights we talk through. So for minority investors, the question of drag along and tag along matters, and then redemption. Redemption can be a way to structure an exit into the project. I realize these are quite technical. The good thing is there's a ton of information online if you're looking to get deeper, and we also have more information as part of the Carbon Finance Playbook. But when you get into the weeds of negotiation, this is also when you obviously want to bring the lawyers into the call.
Great. All right, last section before we get into the final Q&A is just a couple of case studies from projects that that we've seen historically, just to talk through kind of in practice, how did these projects, what did the projects look like, and how did they structure the financing? So the first project is basically kind of a mock-up or an illustrative example of a mangrove restoration project. So this is, blue carbon, deemed to be, these days kind of very high quality and highly in demand nature-based carbon removals. So the project overview, again, this is kind of illustrative, but let's say 50 million trees planted across 5,000 hectares that are being restored, which over the project life will sequester 3 million tons of CO2. So the project is going to restore degraded mangroves, planting native mangrove species. Planting will take, a few years, say 3 years upfront to complete, and the project will then operate for 60 years. So during those first 3 years of planting, there's obviously a large upfront capital expenditure required and no revenues coming in. So as far as how the deal structure could work in this example, so the project developer, let's say the project developer funded the pre-feasibility and the feasibility phases, basically kind of up to right before PDD with $1 million of equity that was contributed by the founders and by a venture capital fund. And then to fund the PDD and the planting and basically the expenses for those first few years before the first issuance, the developer is raising $5 million of basically carbon finance from a carbon fund in the form of a pre-sale. So just looking at some of the deal characteristics here, you have a pre-sale amount of $5 million. Let's say the pre-sale price is $10. That means that you're pre-selling 500,000 credits, and the repayment for that is going to be 40% of all of the credits generated by the project from year 4, which is when the first issuance would happen, through year 18. And ultimately, there's a lot of things that go into this calculation, but a ballpark estimate is that the investor IRR for that pre-purchaser would be around 17% if they're able to basically take those credits and then sell them at the spot market. We would expect mangrove restoration project to be trading somewhere in the $30, $35 price range. So looking a little bit more in depth at the project structure here on the right-hand side. So at the top, you've got the equity investors. Those are the founders and this venture capital fund. They're providing $1 million of early stage funding, basically equity funding into the project developer. So that project developer is basically kind of like the top co-level. That developer then sets up the project SPV and provides all of the funding to that project SPV to do the initial project development work, the pre-feasibility and the feasibility studies, the initial carbon calculations, the community consultations, getting the land tenure, getting the licenses, all of that. And that project SPV also then receives the $5 million in the form of the credit pre-purchase from the carbon fund, which will then fund some of those ongoing expenses, getting the PDD done, getting registered, getting validated, and actually doing all that planting. So those arrows in blue are basically the kind of upfront, let's say, flows of funding. And then the arrows in gray basically show the kind of ongoing relationship. So the equity investors could receive dividends. As Kate mentioned, there's kind of a few different ways that equity investors can receive their return on investment. Most typically for, let's say, like a fund, like a venture capital fund or a private equity fund, it would be in the form of an exit, but it could be in the form of dividends. And those would be coming from the project developer, which is where their equity ownership is kind of housed. The project developer would receive dividends over the life of the project coming from the project SPV. Basically, any kind of excess cash that's generated and is sitting within that SPV could be distributed up to the project developer in the form of dividends to equity. The credits would be delivered. There's kind of two different streams of credits, right? There's for the years 4 through 18, 40% of the credits are going to go to the carbon fund for repayment of the pre-purchase that they made. And the remainder, those 60% of credits during that period, are going to go to other off-takers, corporate off-takers. This would be spot market sales of those credits at kind of prevailing market prices. And then after year 18, there would be no more credits delivered to the Carbon Fund, and the credits would instead all be available for the developer to sell on the spot market to other off-takers. The Carbon Fund itself, the way that the Carbon Fund's economics work is that they actually, they're not using the credits themselves or retiring the credits. So they are selling those credits on to, again, a set of corporate off-takers or potentially even other carbon funds. And they're getting basically payment for those credits. And, they could do that in lump sums, or it could happen over time. There's lots of different ways for a carbon fund to monetize that. They could even execute another pre-sale of credits or something like that if they wanted to take some of that off their balance sheet. So this is kind of like the overall structure of how in projects that we've seen the kind of deal structure has worked for a let's say a nature-based like ARR style project, mangrove restoration project. Looking at a different project type, we wanted to show biochar, which is kind of one of the other more engineered solutions that we are starting to work with, more and more frequently, and which is gaining a lot of attention within the carbon markets. So in this case, quick overview of the project. 6,000 tons of in this case nut shells that are pyrolyzed, so are basically pyrolysis, the process by which you take organic matter and turn it into biochar per year. That results in 1,700 tons of biochar produced per year and 4,000 tons of CO2 removed per year. So the first thing you'll see is that if you compare a biochar project like this, granted this isn't a huge project, but if you compare the volumes that we're talking about here, 4,000 tons per year, to the volumes we're talking about here, 3 million tons, granted that's over the lifetime of the project, 60 years, but still we're in a completely different ballpark. And the reason, there were some questions earlier in the Q&A around, project size and how many, how much carbon do you need to sequester or avoid in order to make a project viable. That depends a lot on the project type, because biochar projects are selling for an order of magnitude higher, price per ton than other, nature-based project, let's say, or renewable energy projects are. So whereas this mangrove restoration project might be able to sell for $30 or $35 per ton, a biochar project could sell for $100 to $200 per ton, let's say. So you can basically make a project work with much smaller volumes. But essentially the way this project works is they'll convert waste macadamia shells or other nut shells into biochar that permanently sequesters the carbon. And that biochar will also, the physical biochar will also be used as a soil amendment on the farms to improve water retention and kind of other measures of productivity. So the way this deal worked, you have a macadamia farm that basically had funded the planting of their plantation through equity capital contributed by the founders. Those plantations now, say we're 5 to 7 years later, are now reaching productive age. And so they're looking to basically raise a bunch of funding to build the macadamia processing facility, which will actually do the dehusking and the deshelling of the nuts. And then the pyrolysis facility, which will convert the waste biomass from that process into biochar. And the way that I've structured this is basically they'll raise $10 million of debt from a consortium of development finance institutions. That debt will have an interest rate of 10%. And then they will also execute a streaming agreement with a carbon fund for another $1 million. And they will sell 30% of the credits that they produce from the project to that carbon fund through that streaming agreement over the next 10 years. So this is, in the Excel example we looked at earlier, the streaming agreement went through the entire project life, which is possible. In this case, it's been kind of a time-bound agreement, so for 10 years. And there's an implied purchase price behind that, about $55 pre-purchase price. That compares to, as I was saying earlier, a spot market sale price of maybe somewhere in the $100 to $150, maybe even $180 per ton. And then that kind of gets that streamer an IRR of, let's say, around 16%. So looking at the structure on the right-hand side, you have the DFIs that are providing 10 million of debt. This will be repaid through interest and principal payments over the course, the duration of that debt, which again with DFIs could be a little bit more flexible and could be a little bit longer term than what you might get from like a commercial bank, for instance. You have the streaming agreement payment coming into the farm from the Carbon Fund. Those are the upfront payments. And then over the life of the project, you have very similar kind of streams of delivery, so credit delivery. So, credit's going to repay that stream, credits that the project has available, 70% of credits to sell on the spot market to other off-takers. Those off-takers will pay the project directly, and then they will also pay the Carbon Fund for any credits that they're off-taking from within that fund. So hopefully this is kind of a quick overview of maybe a couple different projects, and again, these are not, the numbers are not specific to any project that we've worked on, but these are kind of indicative structures, things that we've seen in the past that are entirely feasible as ways to finance projects. All right. So with that, I think we have about 15 minutes left to do our final Q&A and reflections. So we'll go back to the Q&A.
Amazing. And we continue to have some great questions coming in. And so we'll try to get to just about everything. So one of the first questions we had was, in the case of under delivery, does the off-taker or the Carbon Fund take seniority when allocating credits? So typically, in the case of under delivery, a carbon funder, a streamer will have so either there's a fixed volume, right, in the case of pre-purchase, and so if the project under delivers by 50%, but you promised 100 credits to that buyer, you still have to pay that 100 credits to the buyer, even if that is 100 out of 105. So they would have that seniority. In the case of a streamer, right, who's negotiated a percent, they typically will additionally have a minimum delivery quantity as well. So it could be 30% of credits or 100 credits, right? So if the project under delivers significantly, there still is a minimum that needs to go to that streamer first. So that typically there will always be a degree of seniority there. And then again, if the off-taker, if by off-taker, we're thinking someone who's just directly off-taking from the project SPV, that will be junior to the funders of the project typically. Another question was, again, around the non-delivery and penalties. So on average, how severe are cash penalties for non-delivery, and what penalties, and the second question around what penalties are associated with offtake agreements where there has not been upfront cash invested into that project. So in terms of severity, I mean, typically, if capital has been provided to develop the project, the penalty will be related to how much has been invested, right? So if they've invested 2 million, it would be something, and then there has been nothing delivered, it will be benchmarked against that amount that's been invested. And recall, typically investments are always milestone based. So, if you've not reached all the milestones and a lower amount has been invested so far, that would obviously be taken into consideration, and there would be a calculation accordingly. In terms of penalties where there is not upfront cash, it depends. Again, what the buyer really wants is certainty, and part of getting a good offtake agreement is the buyer really trusting that you're going to deliver. And so, the types of penalties can vary. Obviously, it's not going to be the same as when the investor has always as when the off-taker has also put a lot of capital up front. But there can still be penalties, and or if there's a greater degree of uncertainty, then you'll just pay that price in a different way, right? So it may be a lower price, for example, if there's greater uncertainty around that delivery. And in all of these, there's a big part of the negotiation is also what is the process of resolving these things when and if they arise. And so looking at the time period, like what those negotiations look like, what the alternatives are, is part of what you're negotiating after the term sheet phase. Makari, do you
Maybe
want to take a couple?
just a couple of the earlier questions. There was a question around how does the market value credits from different types of projects? So from the measurable, verifiable removals to what is more like inferred avoidance credits. I mean, the reality is that, most, or if not all, avoidance credits rely on some kind of a counterfactual baseline. And so there's quite a bit of calculation that goes into that. Whereas on the removal side, things can be more kind of easily, directly verified. And at the end of the day, the carbon standards and methodologies are set up so that every project is meant to have the exact same impact on atmospheric carbon levels. A ton is a ton is a ton from carbon projects. But the reality is that because of all the calculations that go into some of the avoidance projects and some issues that have arisen from calculations in the past, there has kind of been a bifurcation in the market between the avoidance and the removals credits with respect to price. So you do see significantly higher prices for removal credits, whether those are engineered or nature-based. So, things like biochar or direct air capture or tree planting, compared to the renewable energies, the energy efficiencies, and the like REDD+, for instance, in the nature-based space. Ultimately, as the methodologies improve, hopefully there'll be a convergence again of prices, and you have a lot of new methodologies coming out around some of the avoidance project types that hopefully will fix some of those quality issues. The one other thing that I wanted to quickly address was a question around are there off-takers, are there corporates who are really ready at this stage to invest in projects pre-PDD? I had mentioned earlier that the energy companies are willing to do this. So, they're fairly active especially in emerging markets with early stage projects. They are looking for big volumes and they are fairly risk tolerant. So definitely will come in pre-PDD and are flexible in terms of the types of instruments that they deploy. What I will say is that they're also quite price sensitive. So they're looking for big volumes at lower prices. The really high priced off-takers are more of the kind of tech companies in the US and in Europe. And those companies do tend to be more risk averse. We've spoken to a lot of them, and most of them say, we'd rather just do spot market offtake from projects that are already issuing. We don't want to take on the additional risk of going in early and betting on a project that isn't yet registered. I think that is maybe starting to slightly change, and you've actually seen, like Microsoft, for instance, has done an early stage offtake and even funded offtake agreement with the Pantera project in Latin America. And there might be a few other examples, but I'd say it's early stage, and most of the very kind of high price, high quality off takers would rather wait for credits to be issued.
Yeah. I would just add that most corporate buyers also want to buy the credits as they're issued rather than putting their own balance sheet into projects. So obviously, the counterexamples to that are groups like Microsoft who want to be investing in order to get a lower price. But for many corporates, the only tool they have is either purchase through an RFP or just offtake, but unfunded. So that obviously limits the actual percent of the corporates who would provide upfront funding, period.
There was just a question around returns, and I realize it might be helpful to just kind of talk about returns across the different types of investors really quickly. Nature-based projects, the question was specifically IRRs for nature-based projects. I mean, some investors will view nature-based projects as having higher risks, and in some cases they do, than other project types, but the returns are likely to be more maybe like investor dependent almost. So investors will have specific return targets. And we can talk a little bit about kind of the most relevant investors and what those targets might be. So for carbon funds, what we've typically seen is if carbon funds are coming in pre-registration and doing streaming agreements or offtake agreements, I would say, the minimum returns that we're seeing from those types of investors is maybe 15%. And I'd say it goes up from there into kind of the low or even mid 20s. For the DFIs who might be providing, debt, let's say, to a carbon project or like a forestry or ag project that has carbon, they're, they are probably in the 8 to 12% range interest on debt. So it's fairly market rate debt, honestly, in most of the cases that we've seen. The difference might be that they might be willing to come into projects that are a little bit more perceived to be more risky by the markets, and so the commercial banks might not necessarily go there. For venture capital, private equity, I would say you're in the 20% ranges here as far as the returns that they're looking for. And then, obviously, like coming down into some of these at the bottom here, the family offices, they can be more flexible. You might have some that are very much kind of impact focused and might be willing to do lower returns. The foundations and the governments could be zero. Well, could be you don't have to pay them back at all, or they could be, maybe like returnable grants or something like that would have negative IRRs where you just like repay the principal over some period, but with no interest at all associated with it. I don't know. Let's see.
There are a couple others specifically relating to how this flows through the financial model. So Makari, there's one. How would the cash flows of a recoverable or recyclable grant with some interest rate look like in the financial model, and what would be the impact of that on corresponding IRR or NPV?
Yeah. Yeah. I mean, it depends on the exact structure, but typically a grant would be, if it's a non-returnable grant, then that would typically just come in as revenue, essentially. If it's a returnable grant, then, and it would depend again a little bit how it's structured, but if that's a real liability that you have to repay that in the future, then it would probably look more debt-like, but it would basically be debt that has no interest rate. And oftentimes, what we've seen with returnable grants is that they'll typically be tied to some kind of an outcome. So, a funder might provide a grant to help a project raise capital, bring in technical assistance or investment advisory support. And then when that funding round is actually closed and they receive that investment, then the grant becomes repayable. But if they never raise any capital, that grant wouldn't be repayable. I think either way, from an accounting standpoint, you'd probably put those on the balance sheet, but then you'd have like essentially like a gain, a write-off of that debt and a gain or something like that would ultimately hit the income statement if you didn't have to repay it.
And similarly, a question of how would you perhaps factor in the cost of under delivery or insurance into the Excel model? So,
Yeah.
Of course, insurance would need to be included as a cost for under. But yeah, go ahead, Makari.
Yeah. Insurance, if there's anything that has an explicit cost associated with it, then that would go, on the income statement and on the cash flow statement. So if you're paying insurance premiums for something that's more of a contractual, that would not necessarily show up in, I mean, it would depend. Like maybe there could be certain liabilities that could show up on the balance sheet, but a lot of those, kind of clauses around or covenants around non-delivery, what have you, would probably not show up on the financial statements, but should definitely be taken into account as you're doing like scenario analyses around your future credit production curves, because you might have certain situations where, your production falls to a certain level and now you have an additional expense. And so as you're looking at scenarios, it would be worth incorporating some of those things into the downside cases. Anything else let me just scroll through here.
We've touched on most of these.
All right. Well, we have 1 minute left, so maybe we call it there. Thanks everyone for all the engagement and great questions. I'll put this last slide up, which has our email addresses here if anyone wants to get in touch or follow up on anything. But yeah, really enjoyed this.
Thank you very much.
Thank you. Yeah. Huge thank you to Kate and Makari for the last couple of hours. I'm happy actually to close out our little masterclass series with this, because one of the reasons why we wanted to provide this opportunity was because we've founded a hugely underserved area. And whilst there's a lot of information that is available on project development and the carbon side, we find there's very, very little. And CrossBoundary, the report that Kate actually mentioned right at the beginning, is basically one of the first publications that's been published in more than a decade dedicated to this topic. And yet it's of central importance to the functioning of the market. And as I think you've seen over the last couple of hours, I mean, Kate and Makari have real expertise in this area. So we've been hugely lucky to benefit from that expertise over the last couple of hours. So just a really big thank you to both of them for taking the time to give the workshop. And also to everyone who participated. We had another example of really great questions from a knowledgeable audience. So thank you for coming along, and also to our other workshops if you came to the previous 2 masterclass sessions. We will email you shortly afterwards, maybe tomorrow or the day after, just with the link for the recording. And we will also get back to you in that email about the Excel, because a number of you were asking about the Excel and whether that would be accessible. So wait to hear that, wait to receive that information from us, and then we can distribute it accordingly. But otherwise, it just leaves me to say thank you to our presenters. Thanks all to our participants. And yeah, we hope to see you at another one of these kind of sessions in the future. But in the meantime, have a good rest of your day.